Welcome to the European market open. A minute to go until the start of cash equity trading. I'm Danny Berger in London alongside Tom McKenzie in Brussels.
And here are your top stories. Inflation concerns hit treasuries, yields pop after the US holiday as Wednesday's shock CPI print continues to ripple through markets. COP26 wraps up today, but a deal on carbon trading runs into new obstacles. And a warning over Russia. The US is said to tell allies that Russia may be planning to invade Ukraine.
Tom, let's take a look at the futures this morning. We're not at the dreaded unched, but we are not that far. We're looking at just ever so slightly higher futures markets when it comes to the DAX futures market. A little bit weaker on Euro Stoxx 50. This is, of course, coming off the back of all-time highs on the European equity market. We have these bond gyrations to have to deal with that certainly will make for an interesting market open, Tom.
There seems to be a question that the bond markets are asking of equity traders, which is, are you too sanguine about these inflationary risks and about the odds now of a faster, more aggressive rate hike cycle from the central banks, which will have to at some point grapple with the question. We saw those 5-year yields in the US getting back to levels we haven't seen since February of 2020. Okay, so global stocks are looking at their worst week since about October. But as you say, those are from record levels, record after record, flat today. But of course, equity markets still looking past overall some of these inflationary risks. Here in Spain, you're looking at the Spanish IBEX down at 0.1%. The CAC in France is essentially flat. It's flat as well. You were talking about the unched. Well, we got unched on the FTSE 100. There is nothing to talk about in terms of the UK markets, at least in the first few seconds of the trading session. Of course, we keep an eye, as ever, when it's the focus is on the UK when it comes to what's happening in the commodity space. We know that oil is under pressure. Biden's still keeping investors waiting. And you can see now, Brent is down 0.7%. Will the White House, will President Biden release those strategic reserves? We still don't have clarity on that, and that is weighing on the commodity complex, particularly when it comes to oil. The S&P futures are gaining 0.1%. We're looking for that Michigan survey as well, which may broaden out the picture when it comes to inflation stateside. The 5s and the 30s, you can see that the yield curve is starting to flatten. 5s were up, of course. The longer end of the curve started to come down amid these inflation concerns. The US 5-year currently at 124. That is your cross-asset board just in the first few seconds of the European trading day here. Okay, let's dig deeper into, or let's get the IMAT then with Danny. You can break down what's happening on a sector-by-sector basis.
Yeah, Tom, let me start by picking up with some of those macro themes which you talked about. A more flat yield curve, front end of the curve going higher. You'd expect that that would hurt financials, but we're actually seeing a positive session so far, the open for the financials. At the very start, this was red, this column here, but we're now seeing some improvement. Now, another area that is proving to be resilient to higher yields is had been tech. This is waffling back and forth this morning. We're looking at a mostly red tech sector as well. Of course, valuations coming squarely into play if you think that that future assumed cash growth is now going to have a discount if we are indeed going to have higher inflation and higher rates as a result. Now, we do have staples outperforming, so this would kind of give you an idea that maybe it's a risk off. You want to go into safer sectors, but healthcare, which is at the bottom here, is red. We did get a miss on AstraZeneca EPS, so that could really be weighing the entirety of the sector, seeing some red in consumer discretionary as well. So it is a pretty mixed picture. Really, the standouts here in terms of doing well are staples. tools. So maybe it will be a day, Tom, where if you want to find some outperformance, you might have to go to some of these safer sectors. You certainly won't find it in energy, with energy prices, something you mentioned as well, Tom, with the White House potentially looking at ways to curb that specific area of added inflation.
Okay, let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. Toshiba is to split into 3 separate companies as part of an effort to improve shareholder value. The 140-year-old Tokyo-based firm is responding to pressure from activists after years of scandal and mismanagement. The plan is to separate infrastructure services, technology devices, and Toshiba's stake in a memory chip maker. Alibaba's Singles Day shopping festival posted record sales of $85 billion, offering China's e-commerce giant a boost following a year of heightened regulatory scrutiny. The strong performance could ease concerns among investors grappling with a 30% slump in the firm's shares this year. Alibaba was hit with a record $2.8 billion antitrust fine in April. Beyond Meat shares fell the most in a year after a disappointing sales projection for the fourth quarter sparked concern that the company's growth is tapering off. It's the second time in the past months that the company, which makes fake beef and chicken, has issued earnings guidance that failed to meet Wall Street's expectations. That's the Bloomberg Business Flash. Tom, Danny.
Laura, thanks so much. Laura Wright here in London. Now let's get more into the markets. And joining us now is our markets editor, Christine Aquino. Christine, thanks so much for joining this morning. I mean, what a precarious time it is to be trading in these bond markets. What do you make of the huge jump in yields we've seen so far today?
Well, Danny, you know, it's really emblematic of kind of a momentous occasion that we're looking at in bond markets this moment, right? It's essentially the end of, or the beginning of the end of the era of easy monetary policy. And you can really see that in the way that bond markets have been trading. Volatility is up, and liquidity, or at least some measures of liquidity, are showing a bit more stress conditions, probably the most stress since the beginning of the pandemic in March 2020. And that really is all a sign that there is a big regime change coming in the bond market, and traders are definitely responding to it.
Christine, what is happening? Talk to us about how the hedge fund industry is being impacted by this continuing grind higher for equities, despite what we're seeing in the bond market, at least year to date, that incredible run up for equities. How has that played out for some of these hedge funds, particularly those that are exposed to the short end?
Well, Tom, I think we've seen, news about all of these hedge funds definitely getting burned when it came to their rates bets, because I think they were still betting on lower for longer sort of yields, a bit of a flatter yield curve. But I think or rather steeper yield curve, but I think they got burned making those bets because the bond market has just been reacting to the change in policy a little bit unexpectedly than they would have imagined. I think some of the equities gains this year offsetting definitely some of those losses from trading the bond market. So that's a little bit of good news for the hedge fund industry. But definitely when it came to bets in the short end in bond markets here, and definitely when it came to bets in the shape of the yield curve, a lot of them have been wrong-footed. It's not been a great time for sure in this part of the market.
You mentioned volatility and liquidity, and of course, with these hedge funds having the difficulty they are, what does participation look like right now? Are people not willing to really step into this very volatile bond market?
Well, it's very interesting because, we do have investors who have to be participating, right? You have your primary dealers and just investors who really have to be invested in one way or another, particularly in the most liquid, biggest, and most important bond market in the world, right? And so I think in terms of participation, they are still there, but they're definitely seeing more challenging conditions. And of course, we're heading into year end as well. And so that tends to be quite challenging time for a lot of these funds because they're closing their books and trying to take stock of what's happening and going into next year. And so, yeah, all of this kind of, I think, just contributing to this very interesting time where volatility is high, liquidity is doing not so well, and yeah, just making things a little bit trickier for funds here heading into year end.
Christine, how should investors be thinking about the geopolitics? We got this warning from the US about a possible invasion of Ukraine by Russia. That's on the downside, of course. On the upside, at least marginally, you've got this potential meeting between President Xi and Biden next week. How does that all factor into investor sentiment?
Well, Tom, as you know, investors are infamously terrible at pricing geopolitical risk. I think it's one of these things where they will definitely want to keep an eye on for sure and monitor the developments. But at this stage, it's difficult to say how does this actually translate into concrete policy changes, if anything, right? And so I think it's one of these things where they'll definitely want to have half an eye on it for the moment, you know, see how things progress, but definitely not something that we're seeing at the moment being traded majorly in markets, but certainly something, risk for them to keep an eye on for sure.
All right, Christine, thank you so much. Always a pleasure to have you on. That's Christine Aquino from our Bloomberg team. Coming up, Bitcoin, is it a blockbuster? Movie theater chain AMC now says it will accept the crypto and a few others as a method of payment, and potentially Dogecoin is next. We're going to discuss. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to The Open. We're about 11 minutes into your European trading day, and we're looking at, yet again, all-time highs on this Euro Stock 600, up about 0.2%. It's not exactly even when you look underneath the surface. You're looking at a DAX outperforming, a CAC 40 outperforming, FTSE 100 weaker, but that really might be a factor of some of the FX effects. We're looking at a stronger cable rate, and of course, that stronger pound makes it more difficult for internationals. So often, that's why we see the FTSE 100 buck the trend. But let's check in on some of the stocks on the move at the open. Lizzie Burden is here, and Lizzie, you got your eyes on Deutsche Telekom to start off with.
That's right, Danny. One of the early gainers this morning, Deutsche Telekom posted higher revenue, lifted its annual forecasts, and that's boosted by strong growth in its T-Mobile US division and strong gains across its European divisions because of tourism restarting after pandemic restrictions have eased. The other thing we're watching is Renault, another early winner. The French car maker had its outlook upgraded by Morgan Stanley for 2022, though analysts do point out raw materials headwinds ahead. And finally, AstraZeneca, the biggest loser on the FTSE 100 in early trading. The biotech and pharma giant moved to profit from its COVID vaccine, but core earnings per share in the third quarter missed the average analyst estimate. So we'll be keeping an eye on that.
Lizzie, thank you so much. And yeah, I think that's the biggest decline for Astra, at least so far, since December 2020. Lizzie Burden, thank you as always. Tom, the other corporate story I have my eye on is AMC. And I feel like this is just the most meta of all moves from them. AMC, of course, this meme stock favorite, the CEO tweeting in the early hours of this morning that they're now going to accept Bitcoin, Ethereum, Bitcoin Cash, and Litecoin when you make online payments and buy things at AMC. This just feels like the natural next step for them.
Well, it does, doesn't it? I mean, this is a bit of a nod to their meme investors, right, who have pushed up their stock to, what, 2,000%, up 2,000% year to date for AMC. Thanks to that team of meme investors. They're also looking at Dogecoin as well. I know that spiked your interest as well, Danny. I just have to wonder, the practicalities of using crypto. Do you buy your ticket and then you sit there monitoring the prices, regretting if you see 20% upside in the first few minutes of the film? I don't know.
Yeah, that's true. I mean, it's kind of a weird thing to think about that if you were to buy a ticket with Dogecoin, if the ticket's $25, you'd have to pay with 100 Dogecoin, or as our producer Sarah Rappaport pointed out, I think it's something like 0.03% of one Bitcoin would be the cost of a ticket, or maybe even less than that. So the denomination factor maybe is a little bit more confusing. But, AMC in their last earnings said that they're weighing their own cryptocurrency. So maybe one AMC coin equals one ticket?
Yeah, we'll watch for that. And NFTs as well of some of their major films is what they're looking at. So keep across this space the confluence of movies, the silver screen, and cryptos, and whether or not it's an inflation hedge, as you pointed out in one of our chats. Talking of which, inflation in the US now running at its highest in a generation, of course, with an October CPI print of 6.2%, 6.2%. And the shock is being felt still all throughout global markets. Joining us now then is Supriya Menon, Senior Multi-Asset Strategist at Pictet Asset Management. Supriya, thank you for joining us this morning. Are the equity markets are the equity markets being overly complacent?
Well, I would say that in general, inflation is not necessarily a bad thing for equities. And, it ultimately depends on whether companies are able to pass on those higher input costs, energy costs and wage increases through to their customers. And so you'd see increasing differentiation between companies based on pricing power. And certainly for us, it's meant that we've been more focused on our allocations within equities, for instance, to premium brands as one example. Another one would be payment companies, all expect to benefit from a bit of inflation. Of course, the question is, how does this alter the central bank reaction function in the sense of, it puts them in an uncomfortable spot if you have more persistent inflation and structurally higher inflation. At the same time, they don't want to stymie the recovery, and there's very little they can do about supply side constraints. So the other thing I'd look at is also real yields, which, of course, with break-evens moving much higher, you see real yields at, record lows. So that's actually quite supportive for equities. So it depends on how you look at it, but largely doesn't have to be negative for equities.
It has been really remarkable to look at that real yield picture, Supriya, and as you say, really helping to support the equity rally. But at what point do we get an awakening of those real yields? What will it take to finally push them higher and push them towards positive rates?
Yeah, I think it has to take a significant shift in the central bank reaction function. So you've got a much more hawkish stance from the Fed, for example, in the next few meetings. I still doubt that would be the case. They still see inflation pressures as being transitory, albeit that's being pushed forward into the future. I mean, I think it would need a significant shift by central banks. And right now, what you're seeing is quite varied reactions from central bank. You have the more hawkish end, the RBA, for example, and the ECB at the other end, sort of largely staying dovish and unlikely to raise rates. So you're seeing quite a variety of reactions, and the Fed is not necessarily going to turn more hawkish in my view. So I think real yields can move higher, and we'd expect them to move gradually higher into next year, but we're not going to see this abrupt shift in real yields that would derail the equity recovery.
So that's the support from real yields for equity markets. And then you have the earnings picture, and you see more upside, both for earnings and growth. And of course, the two are linked next year. What is underpinning that conviction?
So underpinning that conviction is relatively strong growth. So we'd expect, so we're a bit above consensus on our global growth expectations. Just under 5% is what we expect next year. And you know, so looking at that, and that's a high nominal growth environment if you combine that with inflation. So ultimately, this is positive for equities because especially in those regions which have higher operational leverage. So I'm thinking here of Japan and European equities. So we'd be more positive on those areas. So for example, in Europe, in the euro area, we'd expect about 15% earnings growth next year. That's quite a bit ahead of consensus. So that leaves us quite positive on equities. And we'd still expect some pressure on multiples, of course, but really a continued rally in equities that is driven by earnings, quite similar to this year, albeit of much smaller magnitude. So that's the picture looking into next year. It's really strong nominal growth, and the fact that margins have been resilient, and we'd expect them to stay that way. Good resilient margins.
Sorry to interrupt. Sorry to interrupt you, Supriya, but I just wanted to jump in because I do wonder whether that story of growth and really overall economic growth, the likelihood of that being derailed if by holding off hiking rates, if by adopting a more dovish stance means that from not just the Fed, but perhaps from the BOE as well, that we get a more aggressive tightening cycle come next year. What is the likelihood that despite the strong earnings picture, that could derail the rally?
Yes, and I think here it sort of depends a little bit region by region. In the US, we'd expect core inflation to peak out at the beginning of next year, so just above 5%, and then fade a little bit towards the end of the year towards 3%. So that's very much, so we're buying a little bit the transitory narrative, although 3% you might argue is still a little bit uncomfortably high for the Fed. So if you believe that, given that that's our forecast, we'd expect the Fed to still be quite sort of gradual in its approach. And, there's about 2 rate hikes just under that price into next year. That's what, I wouldn't expect much more than that. So that gives me a little bit more comfort about, real rates not moving abruptly higher, as I said earlier. When it comes to the Bank of England, I think it's a little bit of a tougher environment, and the kind of stagflationary risk is much higher in the UK, given some of the structural constraints. So here, and inflation is a little bit more, there's more inflationary pressure driven by some of those structural factors. So ultimately, the risk is the Bank of England will have to move, would have to move in this more delayed but more abrupt fashion, and that would be a risk in the UK, less so in the US. So it depends a little bit on kind of the underlying structural narrative in the region that we're looking at.
Okay, the reaction function of the central banks of ever greater importance, of course, but an upside call there, a bullish call there from Supriya Menon, earnings growth of 15%, that's above consensus. Supriya Menon, thank you very much indeed, senior multi-asset strategist at Pictet Asset Management. Okay, coming up, the US is said to have briefed EU allies that Russia may be planning an invasion of Ukraine. We'll get the details next. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Welcome back to the Open. We are 24 minutes into the European trading day, flat essentially across the benchmark. Bit of divergence, as Danny pointed out. The UK, the FTSE 100 down 0.3%. You've got gains of a similar magnitude in the opposite direction, gains of 0.3 on the CAC 40. The DAX is essentially flat, losses of 0.3 on the IBEX. Your US futures are looking at gains of 0.1%. Okay, let's get to a Bloomberg scoop now, and we have learned that the US has raised the alarm with EU allies that Russia may be weighing a potential invasion of Ukraine. Washington says it is closely monitoring a buildup of Russian forces near its Ukrainian border, but Moscow denies any aggressive intentions. Joining us now is Bloomberg's Moscow bureau chief, Tori Clark. Tori, why would Vladimir Putin be interested in doing this now?
Tensions have remained high ever since the 2014 issues with Ukraine, where Russia annexed Crimea and supported a separatist war in the east. We saw in April this year, before Putin had his summit with Joseph Biden, that there was troop buildup along the border. We're seeing that again, and there are concerns that it may be Putin planning a move. At least that's what the U.S. has shared with its EU allies. We're not sure what intelligence the U.S. exactly has shared. Why now? Well, there are a lot of divisions among Western allies. You've got new government in Germany and elections in France and issues with the EU and the UK. It may be perceived that the West is weaker right now.
All right, Tori, really important story. We appreciate you staying on top of it for us. That's Tori Clark, our Moscow bureau chief for Bloomberg. Now, as we look at markets that continue to trade around all-time highs, we talk more about climate change. We talk more about COP. Coming up, Rolls-Royce developing a new generation of nuclear reactors as part of the push to help meet the UK's net zero target. We're going to be speaking to the CEO of the company's nuclear unit. All of that is next. This is Bloomberg.
Проходим опасный участок, ответственный. Рустам, поднимайте нажимари. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком я хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open. We're 30 minutes into your European cash equity trading session. Here are your top stories. Inflation concerns hit treasuries. Yields pop after the U.S. holiday as Wednesday's shock CPI print continues to ripple through markets. COP26 wraps up today, but a deal on carbon trading runs into new obstacles. And a warning over Russia. The U.S. is said to tell allies that Russia may be planning to invade Ukraine. Tom, good morning. Happy Friday to you. We're looking at a bond market that continues to sell off, but equities just have been so resilient.
That concern within the bond markets is not bleeding through to equities. As you say, we're at record highs still across Europe. The MSCI index posting some decent gains as well. You saw strength, particularly in the Nikkei. Japanese stocks performing very well today, and Chinese tech stocks as well, on the view that maybe some of these regulatory pressures are starting to ease. And it was a good session as well for Alibaba on the back of Singles Day and another record there. Here's how things are playing out across Europe, though. You're flat, just gains of almost, just a couple of points, really. The European stock 600 flat as a pancake. But there isn't a divergence. The FTSE 100 is down by 24 points or so, down by 0.3%. You're seeing gains in France. The CAC 40 is gaining 13 points or 0.2%. The DAX is flat as well, again, as the markets continue to weigh up the inflationary pressures, but that angst, that anxiety that you're seeing in the bond markets with that 5-year yield back to February 2020 highs is not really bleeding into the equity markets. We were speaking to Supriya Menon from Pictet Asset Management earlier. She's talking about the fact that real yields remain supportive for these markets going forward, and she sees earnings growth of 15%, well above consensus for next year. In terms of the sector breakdown, here's what you're looking at. Consumers at the top of the list in terms of sector breakdown, up 1.5%, followed by retail and telecom. At the bottom of the list, you're looking at basic resources. You're lower on oil, you're lower on iron ore as well. Travel and leisure also off by 0.8%. That is the shape of play 30 minutes into the trading session here in Europe. Danny.
Of course, the other big theme here in Europe is COP26, really globally as well, the summit entering its final hours, and plenty is still left to play for. A new draft of the climate pact being debated today slightly softens language on asking countries to make deeper emission cuts. Issues around phasing out fossil fuels and a global carbon market still remain unresolved. Joining us from Glasgow is our reporter on the ground, Maria Tadeo. So, Maria, can we start with this new draft out from COP26? What exactly do we make of this softening of language?
Well, you know, here's the thing, Danny. The official deadline for this event to come to an end and get this communique is 6 p.m. local. Right now, it's 8:30 in the morning. A lot can change from now until that deadline, 6 p.m. Now, this early draft that you allude to could be seen as a first working document of the day. So I just want to stress that this is not the final version by any means. Perhaps this conference could run into tomorrow. Now, in terms of the language here, you could argue it does tackle some of the main points, but it has softened the language, particularly when you look at fossil fuels. And this was something that a number of countries wanted to get a very clear, very explicit mention that this conference would signal the end of fossil fuels. Today, well, there is some language around it that perhaps hints you can continue to do it if you also take on measures to deal with it. Then secondly, when you look at this draft statement, you don't really have any guidance in Article 6 and the carbon pricing. This is seen as potentially the biggest breakthrough. To get rid of carbon emissions, you have to be able to measure them and price them correctly. So again, none of that, but as I said, this is 8:30 in the morning, a lot can change, and this is just an early draft. It doesn't mean that this is a final version by any means, and I guess a number of countries will want to push back on this.
Yeah, Maria, you talked about the carbon trading and the essentiality of that, the fact that that is a crucial part of the mix here. What is holding that back? What are the obstacles in place?
Well, you know, Tom, as I said, this would be a huge breakthrough in this conference, the idea of a global carbon market, something that looks like the European ETS, but on a big global scale that has a benchmark and is standardized, and everyone, of course, respects those rules. That would be a real breakthrough. But there are a number of issues that are preventing an agreement at this point. One is what to do with the credits prior to 2020. The second is when you look at those credits or the offsets that would be exchanged between different countries, is this going to be done on a global market, or is this a bilateral deal between countries doing so among themselves? So that's for the technicalities. Then also you need to get countries like Brazil and President Bolsonaro to want to play ball this time. Until now, the mood music was that Brazil was more open now to debating this. Before, the government was very climate skeptic. That may be changing. But again, there's a lot to be played for in the next final hours. The deadline is 6 p.m., but we do hear a lot of rumors now saying this is not ending today. It's probably going to be extended until Saturday. That's best case scenario, could even run into Sunday. So there's still a lot of talking to do.
Maria, really fantastic reporting, of course, not just today, but for the past 2 weeks at COP26. That's our Maria Tadeo in Glasgow. Let's stay with the subject of climate change. British jet engine maker Rolls-Royce has raised more than £450 million along with a consortium to fund the development of small modular nuclear reactors. Almost half of that financing is coming from the UK government as it looks to cut the country's carbon emissions from power generation. Tom Sanson, CEO of Rolls-Royce SMR, joins us now. Tom, first off, thank you so much for joining us. Great to have you in the studio today. So with this funding in hand, what do the plans now look like to develop these reactors?
Thanks, Danny. Yes, we've now got the funding to take the technology to the next level. We this week are entering the technology into the approval process with the UK regulators, and we now have the funds to start to ramp up our engineering capabilities to develop the design and to take that design forward through for regulatory approval here in the UK. But in addition to that, with this backing with our new shareholders, we're also now focusing on how do we actually now start to create the situation for us to deploy the technology, not just here in the UK, but also we're in conversations globally to sell this technology as a UK export around Europe and around the world.
Tom, about 250 gigawatts of renewables were added last year versus just a single gigawatt for nuclear. Because the truth is, this is very expensive and it takes a long time. How does what you're proposing change that?
Well, we've designed the Rolls-Royce SMR specifically to address that cost and delivery challenge. We've designed a solution, the environment, which 90% of the activities in delivering an SMR we are doing in a factory, allows us to then manage the cost and deliver with greater certainty.
So then, with that in mind, what do you say to critics who say we already have types of sustainable power that are less expensive? We already have wind, we already have solar. Why go into nuclear if, despite the fact that there are ways to help alleviate some of the price pressures, as you say, we already have that existing in other forms?
Yeah, well, the big difference with nuclear is it's base load. It's not intermittent. And so as we build more and more renewables into our grid, we need to have the stable base load to provide the clean energy 24/7, and that's what nuclear power does better than any other form of electricity or energy generation.
Tom, what about the concerns around waste, nuclear waste, and how you dispose of that? What are the plans? What are the contingencies you'll be putting in place?
Yeah, well, firstly, the nuclear industry really properly regulates, controls and manages and tracks all of its waste over the complete life cycle. The cost of our electricity, we're expecting to be about 50 to 60 pounds a megawatt hour. That includes in it a small component for a funded decommissioning plan to fund the complete decommissioning and management of the waste streams. But importantly, the footprint of the waste from nuclear is very, very small. As an individual in your entire life, if you relied on nuclear for all of your energy, the amount of waste that would produce would fill a pop can. It's a tiny amount of footprint, and the land use, the waste footprint is managed and is controlled very well within this industry.
So this latest funding round, half of the funding came from the government. Going forward, how do you see that mix developing between the private sector and the government?
Well, I think we're really seeing in the UK strong leadership here with nuclear, the 10-point plan, the energy white paper, the net zero strategy, and that's allowed us to then raise this capital for this next phase. But when it comes to deploying the technology, we've heard through COP26 the amount of private capital that's looking to fund the transition to clean energy. And with this solution, by being a factory-built, commoditized product, we hope to unlock private capital to help deploy this technology globally.
Tom, we know you're looking at a number of potential sites across the UK. I think the number is 16. Can you give us an update on where those sites may be, what the contenders are in terms of your regional preference?
Yeah, well, we've got great locations for our SMR across the UK with the decommissioned nuclear estate. There are many sites that have had a nuclear asset operating, providing base load to the UK for the last 40, 50 years. Those communities are huge fans of nuclear energy. They see the economic benefits. They understand the technology. And so we have many sites that can host our SMR that are not big enough to host the large gigawatt reactors, but are well suited to accommodate our SMR, which is about the size of 2 football pitches. So nuclear communities in North Wales, in Anglesey, in West Cumbria, we could look at deploying a number of reactors there. And beyond that, there is a wider nuclear estate, and then beyond that, there's a decommissioned coal estate. And so these units are going to go into the existing industrial footprint that is currently in the UK.
We'll have the rolling hills of Cumbria and some nuclear reactors as well. Tom, thank you so much for joining us. We really appreciate your time. That's Rolls-Royce SMR CEO Tom Sanson. Thanks again for joining us. Now, coming up after a bruising 2020, luxury is back. But can the sector sustain growth? A new report gives us insight into the trends. We speak with one of its authors. This is next. That is next. This is Bloomberg.
the common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector, in Scotland around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
that I... What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Happy Friday. Welcome back to the Open. We are 43 minutes into the European trading day. Pairing some of the modest gains that we had early part of the session, you're currently flat across the benchmark. Heavier losses in the UK. The FTSE 100 is down 0.3%. You've still got gains of close to 0.2%. Over in France on the CAC 40, in terms of the sector breakdown, top of the list, you do have consumer products at the top. Bottom of the list, travel and basic resources. And Danny, we want to be talking as well, as we look at these markets, just about the demand across the investment space, across the financial sector for talent. That war on talent, you've talked to executives about it, I've talked to executives about it. This is real, and it's leading to very strong wage gains. We talk about inflation and wage gains. We're seeing it very pronounced within the financial sector, right?
We absolutely are. And sometimes even those wage gains, even if they're 8 figures, it's not enough. Our Bloomberg's Hannah Levitt had a fantastic story out overnight telling an anecdote from the derivatives desk over at JP Morgan that despite, again, 8-figure salaries, they can't keep people. One of my favorite things that she mentions in this story is that it's almost FOMO that the reason people are leaving. They're looking at everyone else around them leaving and saying, hey, am I missing a trick? Am I making a mistake by staying here? I don't know, Tom. I might be tempted by an 8-figure salary.
Danny, don't do it. Don't do it. Well, okay, fine enough. 8 figures. Go, run, get it. There was someone else they quoted in this story as well. I love the fact, first 2 paragraphs, they draw you in. Then they tell you they're talking about a trading desk at JP Morgan that's all left. But anyway, the gains that you get, you're normally looking at a 10% bump if you defect. You're now looking at 20% bump. So you have to wonder, in terms of the pocketbook, in terms of the cash in your pocket, what is that doing for you? And your consumer and what you can buy. Yeah. And that takes us on to luxury. See that segue there? Not very smooth, but we're getting there. A report by Bain & Company has found that the luxury market, which is being single-handedly buoyed by Danny Berger and co., it's rebounding in 2021 from last year's historic pandemic-related drop. It says the sector is set to return to 2019 levels faster than expected, but other analysts have been sounding the alarm about the risks posed, of course, by Chinese demand. We are joined now by one of the authors of that report, partner at Bain & Company, Claudia D'Apizio. Claudia, thank you for joining us. You have this report. Give us a sense then of what is driving the rebound in luxury and what we can expect in the quarters ahead.
Good morning. Yes, so luxury is back, personal luxury goods in particular, so finished products more than experiences, already at the level of 2019, driven by local consumption, mainly in China and US, even if also local consumers started repurchasing these products also in Europe, across all different countries. Actually, we had this growth starting from August, September last year, and since then there have been always very strong growth rates. And there is an overindulgence on products, also given by the fact that people are not traveling and not spending on experiences, plus strong ability of the brands to really stay in touch with consumer, with remote selling and all the digital touch point. So very resilient industry and very dynamic.
You mentioned China markets flourishing. Claudia, going into this earnings season, there was this concern voiced by many that the push for common prosperity in China would mean perhaps people didn't want to have that huge Louis bag with LVs all over it that were really in your face. We didn't really see that play through necessarily this earnings season, but is that still a threat?
It is, for sure. The common prosperity announcement is bringing some question mark on the mid-long-term growth in China, even if the current growth is mainly driven by repatriation of luxury spending that Chinese were doing while traveling. So purchases in mainland China have almost doubled in the last 2 years, but yet the Chinese consumers are down in terms of nationality, still 20-25% less than 19. So there is still a big gap to recover. Yes, common prosperity in theory is creating more middle class, is creating a wider luxury consumer base for these brands that have a large assortment, but can create in the short term some luxury shame behaviors, as you mentioned, in particular for various tentacious items, and in particular in the top end of the pyramid, even if we don't know which will be the fiscal measures from the government following the announcement.
Yeah, ostentatious luxury used to be a very big thing in the early 2000s in China, certainly when I was there, but the things have changed quite significantly. Claudia, you do an excellent job in this report of breaking down the segments within luxury. Which parts of the luxury sector are doing better and which parts are lagging?
So if we take into account the broad luxury markets, for sure, all categories linked to traveling and experiences are the ones that are still suffering, in particular the high-end hospitality, luxury cruises, but also fine restaurants, even if in the last months there's been a strong recovery, while both personal luxury goods and cars, but even fine art is strongly recovering. And as I said, there is a real shift from services to products that probably will rebalance when people will be able to have to come back to a real normal life, also in terms of social connection and experiences.
Claudia, can you talk to us about the shift to e-commerce? We learned today, Richemont, in their earnings, they're solidifying and extending a partnership with Farfetch, of course, the online commerce platform for luxury goods. What is that evolution going to look like for these firms?
So the channel itself doubled in the last year and also grew this year. So is establishing as the most important channel together with the physical retail space. You know that these brands have large retail chains. They are really pushing now the channel for that .com to become in synergy with the store, the key weapon to stay in touch with consumers. So we don't expect the physical distribution to be disrupted like in other industries, but yes, probably to be right-sized and to work more in synergy with the e-commerce ecosystem. So beyond the .com that actually has been a strong investment of the brands in the last couple of years, both in terms of infrastructure, logistics platform, and digital marketing, you have also e-tailers and marketplaces like Farfetch that are playing a very important role, in particular delivering to the consumers a wide range of products, editorial content, fashion advice, but yet many of these players are struggling with the brands taking more control on their own distribution.
Okay, Claudia, thank you very much indeed. Claudia D'Apizio on the revival of the luxury sector, partner at Bain & Company. Thank you for joining us. Okay, we will look up next at what's happening in Chinese politics. That's after the Communist Party elite-handed President Xi Jinping an historic mandate. We'll find out the details and talk about the implications. This is Bloomberg.
Hong Kong lost its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the Open. We are 54 minutes into the European trading day. The benchmark stock 600, it's been a little bit choppy in the session. It's currently up. You're seeing gains of 0.1%, still very much in record territory for European stocks. The UK, the FTSE 100, still down 0.3%. You're seeing gains in the CAC Gant, the DAX as well is up by 0.1%, and the FTSE MIB is gaining as well. That is the state of play 55 minutes into the trading day. We're going to talk about what's happening in China, the politics there and the importance of Xi Jinping, the president, of course, of China and the head of the Communist Party there, being given this mandate by the Central Committee as he looks to a crucial year next year, where he's expected, of course, to solidify his position even further, Danny, when we know that he will likely get a third term. We were hoping to cross over to Beijing to get the details on this, but there are some technical issues. Danny, this is important for China and it's important for the world as well.
Absolutely. The last time that China delivered one of these doctrines, one of these resolutions was, of course, Mao Zedong. But China has changed so much since then, as you know, much better than I do. But of course, they're the second largest economy. They have a fifth of the world's population. Of course, they also have one of the biggest militaries as well. So there's a lot more at stake this time around as we look to the continued leadership of Xi.
And you have to wonder if that confidence that President Xi will take out of this will give him more leverage when he talks to President Biden. That meeting is expected next week. There is some views now that there is a little bit of stability entering this relationship, which of course would be positive for all. You had that relationship come together, at least on COP26, with that agreement to work together on climate. So we'll see if anything material comes out of that meeting next week, Danny.
Yeah, and of course, even despite the crackdown on tech, still a banner Singles Day for Alibaba. Yep. Well, that's it for us, Tom. That's the European market open. We have Surveillance Early Edition up next. You're not getting rid of me yet. I'm going to stick around for that to walk you through the next hour. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
I was just finishing what you were saying, Tom.
Thank
November
you.
3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
It's a weakness.
I believe in progressive income tax structure. I believe rich people should pay more in taxes.
Inflation is higher. It's eye-popping. This is a transitory period.
It's going to take a while to dig out of the hole we're in, and it's mostly about getting labor into jobs.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. No big deal. The White House isn't worried about Jerome Powell's trading history. Brainard advocates express concern. A warning over Russia. The U.S. is said to tell EU allies that Russia may be planning to invade Ukraine. The latest COP26 draft slightly softens language on emission cuts, where countries were urged to come up with new climate plans by 2022. The document may only request nations to do so. We're live in Glasgow. First, though, let's get a check on the markets, and it is again this angst in the bond market. We, of course, had yesterday closed for the U.S. Treasury market because of the Veterans Day holiday. Well, today it is off to the races. The first full day we're going to see since that red-hot CPI print, the hottest since 1990, and where we're seeing the most action is in your 5-year yield. That's up 3 basis points at 124.72. The bond vigilantes are in power today. Will these higher yields, will it force the Fed and other central banks' hand to start to react in order to start raising rates? Well, at the same time, we're seeing a yield curve that is flattening aggressively. Now at its flattest since the start of the pandemic in March 2020. If the Fed's hand is forced, is this an about face that might stifle economic growth? Is that the reason why we're seeing the long end of the curve buying start to happen there? Yields aren't keeping up. What does this mean for long-term growth? The red hot readings we're getting now, because of course, if the Fed slams on the brakes, the effect won't immediately be felt now. It is later down the road that inflationary impact is felt. But all of that being said, away from the doom and gloom, you do have an equity futures index that is moving higher by 0.1%. We continue to see this resilience coming from the equity space. Perhaps that's that FOMO, that TINA, or it could just be this continued strong earnings that we've seen. We had some luxury goods reporting in Europe today. Richemont, for example, strong earnings as well. And finally, we're looking at NYMEX crude dropping more than 1.3%. Will President Biden react to some of the higher oil prices? Will they release those strategic reserves? Well, here is where we are in Europe. It really is a mixed day. We have a little bit of that dreaded gray on map markets go on your terminal. Of course, that gray means that it's not moved very much. The DAX and the FTSE among them. The CAC outperforming. Again, it might be some of that luxury space. I mentioned Richemont today with stellar earnings. We're talking to Bain & Co. luxury analyst earlier today who said that luxury is back. So we're seeing some of those consumer companies, discretionary, doing doing well. We're seeing UK underperform. That might be a little bit because of the stronger pound. Well, let's go back to the U.S. story, because Bloomberg has learned that top White House officials don't believe that Jay Powell's sale of shares in a stock index fund last year disqualify him from being appointed to a second term. President Biden has said that he will decide fairly quickly on his Fed chair pick, and met last week with both Powell and Fed Governor Lael Brainard at the White House, according to sources. Bloomberg's Bruce Einhorn joins us now to dig into this. So, Bruce, can you tell us more about what the issue is regarding Powell and his trading, and how that's evolving?
Yeah, it dates back to a trade that Chairman Powell made over a year ago, last October, when he sold an index fund that was worth between $1 million and $5 million. The transaction was outside the blackout period for the Fed. It was months after the Fed had said its monetary policy with the pandemic, but some progressives have drawn attention to it and said that this is a strike against Powell. These are people who are in favor of Fed Governor Lael Brainard, who's an Obama appointee.
So how is this affecting Powell's chances then?
Well, key officials have told Bloomberg that that people working on the nomination see no reason for concern over the trade, and no one has brought up these trades in meetings among advisors when they're talking about the search for the chair. So that said, though, people familiar say that there are people in the administration who still are concerned about this. So it's not a done deal.
Bruce, thank you so much covering the story all morning for us here in Europe. We really appreciate it. Enjoy the rest of your Friday. That's Bruce Einhorn. We're joined now by John Bilton, head of global multi-asset strategy at JP Morgan Asset Management. John, thanks so much for joining us. Good morning to you. Happy Friday. We have so much to cover, but I do just want to linger on this idea of Powell and his renomination just for a moment. Tom Porcelli over at RBC said that because of these high inflation numbers, it's less likely now that Biden will want to shake up the Fed, and especially put someone who might have more of a dovish tilt. What do you make of this debate at the moment?
Well, it seems to be a debate between a known dove and a known very dove. So whichever way we cut it, we're looking at a Fed governor who is ultimately going to be accommodative and is going to be very steady as we go in terms of any tightening of policy. And I think that's really the key message here. I can understand the calls for stability and continuity, and that's oftentimes something which central banks prefer to have. But I think we've got to look at the facts here, which is as we move to the voting members of the Fed next year, excuse me, and it's not just about the governor, we move in a modestly dovish direction. Yes, we've got tapering happening. It's happening at a steady pace, but we would argue that some of the pricing of hikes in the market may have gotten a little bit of ahead of itself now. So certainly we still see the Fed following a fairly dovish tack here, regardless of who's at the helm.
But what if these data prints keep coming in as they do, John? We continue to see improvements in the labor market. We continue to see hot inflationary readings. How does that change, or does it change the Fed's messaging at the start of next year?
Well, I think something to pick apart is let's look at where we are now. We have a supply side situation which has caused some disruption and is causing some pockets of inflation. We have some of that coming through into core. What we also have is an enormous base effect playing through. Now, the very same base effect that's elevated prevailing numbers now, 12 months from now is going to be operating in the opposite direction. We should not be asking where the data is today. We should be looking at the setup in 6 to 12 months' time. And we feel that while there are going to be some lingering levels of inflation, and there is more two-sided risk to inflation today, the current levels, which are obviously elevated and capturing attention, we think will begin to come down as we move through the first and second quarter. And the idea that we've got bond vigilantes, waiting in the wings, let's look at the facts. There's over $30 trillion of G10 global central bank balance sheets. There's only $3.5 trillion of hedge fund assets. Even if all of that were lined up against the central banks, it's kind of, failing to meet the...
Have been not so great at trading these bond market moves. We've had a lot of Bloomberg stories about just the pain that they've experienced positioning incorrectly. John, After all of these gyrations we've seen over the past few months, do we know whether the pain trade at this moment is higher or lower yields?
Well, I think right now we have a fairly neutral set of positioning as we look at it. Ultimately, the way we think about bonds is if you're looking at bonds as an income source, then the reality is they're not going to give you that much. And that's why I think investors increasingly are looking to other asset markets, whether it's equity, dividends, real assets, etc. If you're using bonds to hedge liabilities, they still work. So ultimately, there is going to be prevailing demand for bonds at really any yield level. That's one of the reasons why I think we've been able to see negative real yields in the Eurozone persist as long as we have, because there's still a mechanical reason for portfolio construction for that demand for bonds to be there. And I think that that's something which gets missed. But one thing we can argue today is that the pricing mechanism in bond markets has to a degree been compromised because of the large amount of central bank activity. And so where the fair pricing of bonds is not entirely clear. That said, that demand persists because of liability management, because of rebalancing at all of these different yield points.
And John, just quickly here, we have just about a minute left until break. Does that mean that the equity market can ignore the signals coming from the bond market and continue to chart to all-time highs?
Well, I think that the equity market responds to shocks. Sometimes equities can continue to grow and they will have that operating leverage, which means earnings can continue to grow. Were we to be seeing more of a persistent inflationary shock and we saw a drop-off in growth, that's a bad environment for all of those assets, bonds and stocks alike. The reason we push back on that whole notion of stagflation, which is what could undermine equity markets, is because we've got a great capex cycle going on. Investment spending is picking up, household balance sheets are strong, and we're seeing that earnings delivery coming through. So we believe in higher nominal growth, not in stagflation, and that's a good backdrop for equities.
Okay, John, we have much more to dig through. You're going to stick around with us. That's John Bilton from JP Morgan Asset Management. Coming up, we're going to look at the long-term outlook. JP Morgan, John Bilton and friends urging investors to look beyond traditional assets for higher returns. As he was just mentioning, we're going to get more insights as we talk long-term capital market assumptions. This is Bloomberg.
Crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
I believe in progressive income tax structure. I believe rich people should pay more in taxes. The question we have to deal with as a nation is coalesce around the question: what should the maximum tax rate be on wealthy people? Because that will define the revenue yield to the government. The government has to size themselves to that revenue yield. Okay, and all this talk about wealth taxes, it's all baloney. They said let them close the loopholes.
Billionaire investor Leon Cooperman there on his views on taxation, the baloney of taxation, and more as well. Now, almost 2 years after the pandemic struck, the global economic recovery has strong momentum. JP Morgan Asset Management's message is optimistic. Despite low return expectations in public markets, there are plentiful opportunities for investors. In their 2022 long-term capital market assumptions, JP Morgan urges investors to look beyond public markets, and they see bonds as serial losers with alternative asset holding the best return potential. John Bilton, head of global multi-asset strategy at JP Morgan Asset Management, is still with us. John, I find this report so fascinating also because often we're just too concentrated on the short term, but here you were able to look out 10, to look out 15 years from now. The concern overridingly has been what scars will the pandemic and the economic implications have on society. What is your assumption?
Well, as we've looked at it, it's really a crucial statement that we make at the beginning. We've called the whole report "Fading Scars, Enduring Policies" for exactly the point that you raised there, which is that a year and a half ago, we were going through the deepest recession in 300 years, judged by UK history. And what that basically meant is we were deeply fearful that there would be major economic scarring in terms of bankruptcies, unemployment, etc. And certainly we've gone through a shock as a society. But as we've picked it apart and we've looked at the machinery that really supports the global economy, it's an optimistic message. And in fact, there's relatively limited scarring. Why is that? It's because of the huge policy response that we saw. And it's the policy response and the implications of that which we believe are the legacy of the pandemic. Mercifully not the bankruptcies and the unemployment that we saw as being a risk 18 months ago. What does that basically mean? We're dealing with a world where we've got fiscal and monetary policy that have pulled in the same direction. We've got significantly easy monetary policy, much more two-sided inflation risk. So a backdrop of negative real interest rates, but also a burgeoning investment cycle. That can create a lot of positives, but it also means we've got to step carefully as we think about asset allocation.
Well, in terms of that asset allocation, you write in your outlook about bonds as well. Well, we have a dire outlook for government bonds as well. Is there a chance that heading into the next decade, we will have ended the multi-decade bull market for bonds that we've enjoyed, again, over the past few decades?
Well, I think that one thing that we would expect is that rates will go up, but they'll go up very slowly. And the reason for that is, if we look in the short term, and we heard this last week from central banks, bringing it from the very long to the very short term, they really don't want to derail this recovery. But as we look further out, actually the huge amount of demand for duration, both from central bank balance sheets and from other non-price sensitive buyer blocks, means that it's going to be very difficult for rates to go sharply higher. That's why I push back on the idea of bond vigilantism. But what it does mean when we've got growth going on that is looking reasonably solid and we've got two-sided inflation risk, backdrop of negative real interest rates, you don't need bond yields to go sharply higher to have a miserable time if you're a bondholder earning a negative real return. You're going to erode your capital through time. And that's why we are avoiding bonds where we have a choice to do so.
John, you and the team also write in the report that it's time to look beyond public markets. Over this week, I was just in Berlin at the Super Return Conference for private equity, and everyone there was really optimistic. But the problem that everybody continues to speak about are these high valuations. How do you escape this problem if you shift to private markets? Because it's an issue that public markets are facing as well.
Well, I think valuations are always, brought back to a very simple price-earnings relationship oftentimes, and that can be a little simplistic. Because at the moment, coming out of this recession that we've seen and coming into what we think is a strong period of growth, we'll see earnings improve, and we've seen it already, valuations tend to drift down as the earnings improve. If you've got a PE relationship, either the P can come down or the E can go up. And we think the E goes up, and that eases some of the valuations. But if you look more widely, across equity markets, you've got huge cash flow generation from some of the larger blocks. You've got reasonable outlook in terms of return on equity. So we don't feel that the valuations on the earnings line are the only thing to look at. And then in terms of private markets, one of the things that we do think is it's opening up exposure to new technologies, to new ideas, especially the green agenda and the investment in renewables that is going to be supported by private markets, we think is a hugely important thing that investors need to be looking at in all of their asset allocation, private and public alike.
John, really great to have you on the program today. Really great catching up with you. That's John Bilton, head of global multi-asset strategy at JP Morgan, talking about markets today and into the future. Let's get now to the Bloomberg First Word News. Here's Leanne Gerrans. Good morning, Leanne.
Danny, and between Moscow and the EU over migrants and energy supplies. Sources tell us Washington is monitoring a buildup of Russian forces near the Ukrainian border. Meanwhile, Germany's Angela Merkel spoke with Russia's President Vladimir Putin for a second day in a row over the escalating situation on the EU's eastern border. That's after Belarus threatened to shut down a key pipeline carrying Russian gas to the European Union, escalating a migrant dispute. Now, Chinese President Xi Jinping has won a mandate to potentially rule for life as a major political meeting has wrapped up in Beijing. Xi has delivered the first doctrine on Communist Party history by a Chinese leader in 40 years, joining only Mao Zedong and Deng Xiaoping. And official statements highlighted Xi's communist prosperity drive and efforts to promote self-reliance in both science and technology. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Coming up, job hopping on Wall Street ramps up. We take a look at why the major banks are struggling to retain talent, even with 8-figure salaries on the line. That's next. This is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Let's go.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's turn to Wall Street, which is struggling to retain talent as job hopping ramps up. Banks are trying to lure workers with 8-figure salaries, but it's no longer just about the money. For more on this, we're joined by our Lizzie Burden. I mean, Lizzie, an 8-figure salary, I feel like that would be hard to turn down. Why are people turning it down and looking for jobs elsewhere?
It'd be enough for me. We've got this backlog of pandemic moves, a backlog of moves that's built up during the pandemic. And it's not just about the money, although you have got these rival firms circling the big banks, dangling those 8-figure packages, as you mentioned. It's also about lifestyle. So lots of bankers are fed up because they feel underappreciated, having put in the hours during 2020, and then now they're being told that it's uncouth to dole out big bonuses still during the pandemic. So what can they offer in lifestyle? Better work-life balance, more working from home, working remotely, fewer hours. And that's tempting, especially when you've got CEOs like JP Morgan's Jamie Dimon pressuring bankers to get back in the office and extending their own tenure. It makes rising stars want to look elsewhere to make their own mark. But it's not just at the top level, it's also all the way through. When you've had the Black Lives Matter protests, there's fierce competition for women and minority ethnic candidates, which is arguably a good thing, but this is going to be expensive for banks.
Well, Lizzie, if someone offers you an 8-figure salary, I'm not allowing it. You're not allowed to leave us. I'm keeping you on side. Lizzie, thank you so much for your excellent reporting. That, of course, is our Lizzie Burden. Coming up, we're going to talk more about climate, more about COP26, where negotiations over phasing out fossil fuels and carbon trading go down to the wire. We have the draft text of the communique. We're going to be live in Glasgow for the latest with our Maria Tadeo. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The latest COP26 draft slightly softens language on emission cuts, where countries were urged to come up with a new climate plan by 2022. The document may only request nations to do so. We're live in Glasgow. A warning over Russia. The U.S. is said to tell EU allies that Russia may be planning to invade Ukraine. And AMC says it'll accept crypto in a possible nod to meme investors. The CEO says it will accept Bitcoin, Ethereum, and Litecoin, and Dogecoin, maybe at a later date. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the big moves today, they're not in Dogecoin, they're not in Bitcoin, they are in your U.S. bond market. Of course, it was closed yesterday for the Veterans Day holiday, so today we are off to the races. The first full trading day in response to that CPI printing, which was hot, hot, hot. We're looking at a 5-year yield that's up nearly 3.5 basis points and a yield curve that is at its flat since March 2020. Are the bond vigilantes at it again? Our last guest, John Bilton from JP Morgan Asset Management, takes issue with that view that the bond vigilantes can have this impact on the Fed given the size of the Fed's bond buying program and that of the hedge funds. Now, we continue to see resiliency from the equity market. Yes, European equities are slightly lower, but S&P 500 futures more or less unchanged to slightly of that. And that's, of course, COP26 summit is entering its final hours, and there's still plenty left to play for. A new draft of the Climate Pact being debated today slightly softens language on asking countries to make deeper emission cuts. Issues around phasing out fossil fuels and a global carbon market still remain unresolved. For more, Maria Tadeo joins us from Glasgow. So, Maria, you've been there for the 2 weeks. What do we make of this release of the draft of the communique, slightly softening the language?
Yes, Danny, and look, here's the thing. It's been 2 weeks, but this is now about the technicalities and the technical details. This is negotiated by officials that are usually behind the scenes. You don't actually get to see them a lot. These are not the big speeches, and this is not the big government. It really is the technical work that goes on behind the scenes. Now, today we did get the first draft, but Danny, this is a 6 p.m. deadline. A lot of things can change from now until then. And here's something that really caught my attention, and this is the beauty of an event like this. There's also debate around the language. For different countries that may not speak English as their first language, the language may mean one thing, for another means another thing. So this is the beauty of an event like this. But you're very right that it does seem to be, on a general picture, a softening on the language, especially when it comes to the fossil fuels. Remember, at the start of this conference, the idea was to make it very clear, very explicit, phase out fossil fuels. The new text says they call on everyone to accelerate the phase out of unabated coal power and remove inefficient subsidies for fossil fuels. His language very similar to what we heard at the G20, and at the time, I'm sure you remember, that was seen as a big disappointment.
Maria, one of the sticking points, I know this is something you've been speaking to with a lot of the folks there at COP, as well as Article 6, the global carbon market. Are we expecting any changes, any breakthrough there?
Yeah, and Danny, perhaps that could also be one of the biggest breakthroughs of this conference. When you look at carbon, is this idea that if you want to remove it, you have to be able to measure it and you have to be able to give it a price. That is an incentive to move away from it. As you know, this carbon market and this carbon pricing that would see countries exchange credits and potentially compensate some of the poorer nations has been an idea in the making for years, but it's the technicalities, the benchmark, and potentially a levy that is still yet to be debated. Now, the thing that really gets my attention is that we haven't seen anything new on Article 6 for 24 hours. There's been no leaks on that. So for the time being, there is no indication that we're headed for a breakthrough. But again, Danny, this is an ongoing conference. We hear a 6 p.m. deadline, but it could go into tomorrow and potentially Sunday. So there is a lot of talking to be done here at COP26 still.
All right, Maria, and you'll keep us updated through all of that, I'm sure. Our thanks to Bloomberg's Maria Tadeo, live on the ground in Glasgow. Let's get now to a Bloomberg scoop, and we've learned that the U.S. has raised the alarm with EU allies that Russia may be weighing a potential invasion of Ukraine. Washington says it's closely monitoring a buildup of Russian forces near its Ukrainian border, but Moscow denies any aggressive intentions. Joining me now is Bloomberg's executive editor for international government, Rosalind Matheson. So, Roz, why would Putin be interested in doing this now?
Well, the interesting thing about Vladimir Putin is that he doesn't actually have a lot of economic power aside from energy, but he's very influential, and he becomes influential by causing trouble. He picks the right moments to meddle in things, be it in the Middle East or Africa or the US or elsewhere, and he gets attention. And he's probably looking around at the moment and saying, well, the US withdrew from Afghanistan. That was very messy, but the clear signal is the US is going to be very reluctant to get militarily involved anywhere in the world. Again, Europe's very distracted. The big leader of Europe, Angela Merkel, is on the way out. In Germany, they're arguing over Brexit. There's lots of tension between Western and Eastern Europe over issues around migrants and borders. So perhaps this could be a moment where he could actually go in and do this and arguably get away with it.
Well, the U.S. clearly is having some concern here, considering the warning that they're giving. So what, and if anything, can it do to deter Putin?
Well, it's very clear by the noise level from the U.S. administration, comments from various officials that they are concerned, and they're probably trying to get ahead of this, because while there has been a military buildup again by Russian forces near Ukraine, it's not at the level that it was in the spring, and that was a really, really high moment of tension. So perhaps they think if they can lean on Russia now to not put too many troops there, not put too many tanks there, that they can get them to sort of slow this down. They can avoid the worst case scenario. But clearly they are concerned, and so is Europe, because Angela Merkel has spoken with Vladimir Putin twice in just the last few days, arguably about this as well. So there's obviously diplomacy that's going on to try and tell him this is not a good idea and please stand down.
Well, the other thread of this story, Roz, is, of course, Lukashenko, the president from Belarus, who's threatened to cut off Europe's gas supply. How likely is it that we'd get to that point?
Well, very much the key question here again is Putin, because, of course, Lukashenko is very isolated in the rest of the world. He's cut off economically, and his big supporter, the man who backs him and probably tells him what to do some of the time, is, of course, Putin. So the question is not so much is Lukashenko intent on doing this, but would Vladimir Putin see that it makes sense to do this? And he's obviously speaking through the leader of Belarus on this. You would say that this is probably a threat at this point in time. Even Putin knows that cutting off gas is a big move to Europe, particularly as he wants to get his own Nord Stream 2 pipeline up and running with Germany. But certainly it's showing that he's speaking through Lukashenko and trying to get Europe's attention on this issue.
So, Roz, what are the next things that we're watching out for as this evolves?
We need to watch the level of diplomacy. Certainly you can expect to see comments coming out from organisations like NATO, which will be saying very clearly, like, we're ready to come in and defend Ukraine if needed. We have US officials who'll be coming through the region in the next couple of weeks who'll be saying the same. So basically it's a lot of conversation to say very vocally to Vladimir Putin, please don't do this. You can also expect warnings to pick up from the US that if he were to take some sort of action, that they would come on hard against him in terms of sanctions. And what we've been hearing potentially is that could even involve things like coal. So what you're going to get is sort of an escalation in economic penalties on Vladimir Putin. And that might be the one thing he does listen to, because, of course, his economy is very much struggling and his people are kind of unhappy, and he's very acutely aware of that. So he does need to avoid further screws being tightened on him economically.
Roz, excellent reporting. Thank you so much for staying on top of this for us. That's Bloomberg's Rosalind Matheson. Coming up, decarbonizing air travel. We're going to speak to the CEO of ZeraAvia, a company that's looking to cut emissions from aviation with hydrogen electric aircrafts. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the resumption of travel is a bright spot for the aviation industry that had been among one of the biggest losers during the pandemic. But this, of course, coincides with a greater awareness of the carbon footprint of the industry. My next guest believes that the future of flight is renewable hydrogen. Joining us now is CEO of Zero Avia, Val Miftakov. So, Val, first off, good morning to you. Thanks so much for joining us. So, why is the answer hydrogen and not, for example, as we heard from United, buying sustainable fuel? Why is it going to be hydrogen that is the future of this industry?
Thank you, Dana. Good to be here. The reality is that we will need a lot of different solutions to move the industry over to a sustainable future. But the reason we believe hydrogen electric is ultimately probably the best choice is that it combines the very high energy density of hydrogen and very high efficiency of electric approach and low maintenance cost of electric approach to produce a true zero emission option. Zero emission at the airplane, so it's not just net zero on the carbon side, but it also eliminates all other pollutants such as soot particles, nitrogen oxide, and high temperature water vapor, which are also climate agents for aviation because of high altitude emissions.
And of course, Val, you founded this company in 2017. How has progress been? And specifically, when could we actually see commercial use of hydrogen electric powered planes?
Absolutely. The progress has been phenomenal. We're just 4 years old, as you mentioned, but we have already built several prototypes, flown several prototypes. We're flying 20-seat planes later this year in the next 2 months. We're looking to fly a 70-seat aircraft with our engines in 2023. And in terms of commercial deliveries, in 2024, we've already announced our first international hydrogen flight between Rotterdam and London. So the first commercial launch is going to happen in 2024, and then the larger aircraft, 70-seat, 80-seat aircraft, will be 2026. And we already announced the partnership with Alaska Airlines as one of the launch partners for that. So the progress has been phenomenal.
What have been the barriers to getting more in circulation? What do you have to overcome to get to these goals you're talking about?
Yeah, so there are some technical barriers, and of course we're working on them, and that's why the company exists. And we're a deep tech company working on some of the hard problems, mostly on the weight of the systems and the power density of the systems. But there are also some policy and market problems as well, which are intertwined a little bit. And this is around how we're going to, once technology is available, how are we going to incentivize the transition of the market? And operators like British Airways, Amazon, and Alaska, and all the others that are already our partners to these new fleets, to these new engines, and the infrastructure as well.
What is the purpose of partnering, as you say, with British Airways, parent IAG, Amazon? What do these existing very large companies and large air carriers bring to the table?
Yeah, a good question. They're all very interested in getting their fleets, getting their operations to the clean future, and they see hydrogen electric as one of the key approaches. So they do look to partner with leading companies in these spaces so that when the technology is available, they're in front of the line. So we did, over the last 2-3 weeks, we have announced commitments from a number of players, manufacturers, and operators for over 500 engines or 250, 300 aircraft. And this, of course, fills up the production pipeline that we have, and therefore allows people who are the first in line to get to this clean future faster.
It's also COP26. It has been for the past 2 weeks. And of course, within COP, there have been days dedicated to transportation. Heading into the conference, we did have in October the International Air Transport Association member airlines passing a resolution that commit them to net zero carbon emissions by 2050 from their operations. What do you make of that target? Is it ambitious enough? Should it go further?
It's quite ambitious. If you think about aviation as probably the hardest sector to decarbonize and clean up, because of the energy intensity, you have to take all your fuel in the air, and you can't take a lot of mass. It is quite ambitious targets. Now, it will be, as I mentioned in the beginning, it will be achieved by a combination of factors, combination of solutions, and sustainable aviation fuels, so synthetic fuels, as a part of the solution, especially for long distance, long haul travel. But we believe hydrogen electric will become a significant portion by then as well, probably beyond 25%, and over a longer period of time, even higher.
Okay, Val, thank you so much for joining us this morning. We really appreciate it. That's Val Miftakov, CEO of ZeroAvia. I also just want to bring us some lines coming from the Kremlin saying that Russia to supply gas to EU regardless of Belarus. Of course, there was this threat coming from Belarus about gas supply to the EU as we have the migrant issues arising. We were just talking to our Ross Matheson about this. At the same time, Russia also saying that Russian domestic troop movements are a domestic matter. This is something the U.S. had gotten involved in, warning the EU over a possible invasion of Ukraine. Of course, this was a Bloomberg scoop. At the same time, Kremlin also saying Belarus didn't discuss EU gas cutoff threat with Russia. So those are the lines coming out there. We are seeing still gas futures move higher today. So we'll stay on top of that story for you throughout the program. Let's first, though, get to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Toshiba will split into 3 separate companies as part of an effort to improve shareholder value. The more than 140-year-old Tokyo-based firm is responding to pressure from activists after years of scandal and mismanagement. The plan is to separate infrastructure services, technology devices, and Toshiba's stake in a memory chip maker. Now, Cartier owner Richemont says it's ready to give up control of its unprofitable Uvex Net-a-Porter online business. The luxury goods maker is in talks to sell a stake to Farfetch and adopt the rival's technology. Activist investor Dan Loeb is reported to be pushing Richemont to turn around its struggling e-commerce operation. Alibaba's Singles Day shopping festival posted record sales of $85 billion, offering China's e-commerce giant a boost following a year of heightened regulatory scrutiny. The strong performance could ease concerns among investors grappling with a 30% slump in the firm's shares this year. Alibaba was hit with a record $2.8 billion antitrust fine back in April. And Beyond Meat shares fell the most in a year after a disappointing sales projection for the fourth quarter sparked concern that the company's growth is tapering off. It's the second time in the past month that the company, which makes fake beef and chicken, has issued warning guidance that failed to meet Wall Street's expectations. And that's your Bloomberg Business Flash. Well, Danny, I keep buying them because, as you know, I'm vegan, so a little bit so Beyond Meat is lots of it in my fridge.
I was about to say, Leanne, clearly you're not keeping up your vegan meat buying enough, because Beyond Meat, they need you there in the grocery stores, Leanne. I don't know, are you just too into salads these days to help Beyond Meat out?
No, I'm just completely slacking, and I'm definitely not into salads. I feel like I'm getting into soup, so I don't really know what's happening. But yeah, plant meat is definitely something that's a staple in my house.
Well, Leanne, thank you so much. That's Leanne Gerrans in London, of course, our resident vegan. Coming up, we're going to stray away from Beyond Meat, but it is a meme stock, which brings us to AMC. Can you now use Bitcoin to pay for your cinema ticket? AMC will accept the biggest cryptocurrencies as a payment method. We're going to discuss that next. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. AMC now accepts Bitcoin, Ethereum, Bitcoin Cash, and Litecoin as online payment methods. The crypto options join Apple Pay, Google Pay, and PayPal payment options at AMC. The CEO, Adam Aron, announced the news in a tweet in the early hours of this morning. Let's bring in Bloomberg's crypto expert, Joanna Ossinger. So, Joanna, I mean, this is just another instance of AMC really leaning into its meme status. Talk to us about what exactly they're doing with cryptocurrencies.
Hey, Danny. So it is pretty interesting. They're taking several. They're not just taking Bitcoin and Ether, but also Bitcoin Cash and Litecoin. And then they say that Dogecoin, everybody's retail favorite, is the next. So they are looking into doing even more, but it does seem to be a part of a broader strategy to appeal to, say, younger customers and tech-savvy people.
Yeah, can we dig into that a little bit with this strategy? Because, I mean, this isn't something that directly appeals to people getting into the movie theaters. Is this just a bid to get those Wall Street bet type people to continue to buy AMC?
It might be, and of course, they're up. The stock is up 1,700% year to date, so it is quite high. But they've talked about even doing their own cryptocurrency. They've talked about doing non-fungible tokens, NFTs. So they are hitting all the buzzwords as they work to figure out their broader strategy. So it is definitely something where, you know, Wall Street Bets probably is considering AMC based on some of these things.
Well, beyond the crypto world, beyond the meme world, we did have their earnings not too long ago. What is the outlook generally for AMC?
Well, if you look at analysts, it's actually not that good. They have 3 holds and 6 sells, according to Bloomberg data. People have the target price at about $5.40, and it's right around $39 now. So just with this meme stock excitement and everyone rushing into it in the middle of the year, it's gotten to a much higher level than people think is justified by the fundamentals in terms of the analyst community.
Well, perhaps the Doge will save them. Joanna, thanks so much. Really appreciate it. That's Bloomberg's Joanna Ossinger. Now, we continue to look at markets that are hovering around their all-time highs, that we are looking at slight weakness in the European session. We're going to continue that markets conversation. Bloomberg Surveillance Early Edition is going to continue in the next hour. Anna Edwards in London, Matt Miller out of New York, and Lisa Abramowitz joins him in New York City as well, as we try to digest these big bond market moves. This is Bloomberg.
хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Тоже это не просто, в чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. Ну, то есть второй будет проще.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time?
What did you say about me? What did that particular gentleman say about? Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I think this inflation is a multi-year process.
There's a great deal of pain, both pain to households and political pain being felt in Washington over this inflation.
I think we have to be flexible, and I think we also have to really define what transitory means.
Inflation not as high as it is at the moment, definitely, but certainly could be a little bit higher. Does that, derail the market? I mean, I think it makes it pretty bad news for the bond market.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lyons.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. On this Friday, November the 12th, our top stories today. More fallout from inflation. Treasuries resume their slide on concern that the Fed will be pressured to raise interest rates sooner than expected. Sounding an alarm on Russia, the United States warns the European Union that Moscow may be planning an invasion of Ukraine. And who picks up the tab for curbing rising temperatures? Delegates at the climate summit try to reach agreement as the conference in Glasgow enters its final hours. I'm Anna Edwards with Matt Miller and Lisa Abramowitz in New York. Kayleigh Lyons is off this week. Welcome to the program, everybody. Welcome to Bloomberg Surveillance Early Edition. And Matt, a bit of geopolitics to throw into the mix then, on top of the weekend's theme, which has really been about inflation and the bond market still moving on that. Better mood music around China, though, lifting sentiment in Asia.
Yeah, absolutely. The Chinese sentiment is good, and we're still preparing, remember, for that meeting between President Biden and President Xi. But the geopolitics is really driving the narrative on this Friday morning. Take a look at what's going on in the Asian stock market here. This is the Hong Kong Tech Index, HS Tech, and you can see it's doing very well, up more than 1.5%. The idea is that regulation may be coming to an end there, or at least plateauing, and that's driving gains in South Korea. The Kospi up 1.5%. It's driving gains in India. The Sensex up 1.25%, and the Nikkei up 1.1% as well. So stocks doing well in Asia overnight. Here's a picture of what's going on in Europe. Much more of a mixed picture. You see the FTSE down 0.5%, the IBEX down 0.2%, the CAC 40 up 0.2%, the DAX and the FTSE MIB not doing much of anything. So still looking for a little direction there. And the geopolitical story, of course, is much more important here. We do have a lot of corporate news out of Europe, some of it very good. For example, Richemont, well, shareholders like it. Richemont, which is the maker of Cartier and Vacheron Constantin watches, right now up almost 10% because they've pulled out, or they're deciding to pull out of a deal. They wanted to go it alone on an e-commerce platform, and now they're going to sell a stake in Net-a-Porter to Farfetch in London, and investors are happy that they weren't going to make that outlay, spend that money to go it alone. Instead, they're going to work with the industry. Deutsche Telekom, better than expected in terms of profitability, and raising their full-year forecast as well because their U.S. unit, T-Mobile, has done well, and because European customers are traveling around, leaving the country, and that boosts roaming fees for DT. Renault is up as well. They were down big yesterday because Daimler sold the rest of their stake in the French car maker, but now they're getting an upgrade, for example, at Morgan Stanley, which says production should be better in 2022. They should be able to make more cars next year, and that's going to help the bottom line. And there may be a little bit of a buy the dip going on there as well. AstraZeneca, a very interesting story. I know for you in London, they've done worse than anticipated with a cancer drug. The growth in China, some analysts say, looks a little bit weak, a little bit too slow, and they're going to press on with their no-profit strategy for the vaccines, which I guess is altruistic, but isn't helping the bottom line. And as a result, AstraZeneca, one of the biggest losers on the stock 600.
Thank you so much, Matt. Heading over to the U.S., I think that really the story is resilience, the ongoing resilience of equities despite this higher inflation rate. And frankly, the sell-off that we've seen, particularly on the short-term rates in the United States. You can see the S&P is gaining about 0.1% ahead of the open, but this would be the first monthly loss for the S&P on a weekly basis going back to early October, and it's down, oh my gosh, gasp, 1%. I mean, this is not a major move, and we saw the highest inflation read going back to 1990 in the United States, and you have a pretty big sell-off on the short end. The two-year yield is what I'm talking about, 0.53%, a huge round trip. We plunged after we've got some dovish commentary from a number of central bankers, and now suddenly people are saying, wait a second, these Fed officials are going to get checked by inflation that is coming in repeatedly higher than expected. I do wonder why this has not led to a greater amount of volatility on the equity side. Crude actually is lower. Its longest string of weekly losses going back to March. The idea here is how much can the Biden administration unilaterally go into it alone and possibly combat higher gas prices with some sort of release from the Strategic Petroleum Reserve? Do they really want to do that? I think really to watch is the division on the Biden administration over whether or not to take some real material action. The dollar basically unchanged, but we are looking at about the strongest levels for the greenback going back to November last year. Anna, it is all about policy divergence this week, and frankly, looking forward as we take a look to a Federal Reserve that might be checked by inflation. Yeah, we spoke to an FX analyst who was saying it really is all about that policy divergence, interest rate differentials globally. Certainly a theme we will revisit and revisit. Let's get to your look ahead, a look at some of the items on our agenda today. It is the final day of the COP26 climate talks in Glasgow. China is likely to oppose efforts to phase out coal. We're watching for what the final communique, we've seen a lot of drafts, what it will say around fossil fuels. At 8:50 a.m. at New York time, ECB chief economist Philip Lane speaks at the European Commission event about the future of the EU's fiscal governance frameworks. Is that the kind of occasion where he pushes back against market assumptions of monetary policy? We will see. And then at 10 a.m., we will also get consumer sentiment data out of the University of Michigan. Really crucial to watch. Such a big part of the U.S. economy, of course, an economy that is feeling the pressure from higher inflation, but also savings levels, fairly robust, obviously, coming out of the pandemic. Now let's get to the geopolitics. We mentioned this in our headlines, really important to flag this to you. A warning from the United States on Russia. Bloomberg has learned that Washington has told the European Union that Russia may be considering an invasion of Ukraine. For more, we're joined by Bloomberg's executive editor for international government, Ros Matheson, who can give us the context that we need to know here. Ros, good to speak to you. So why would Putin be interested in an invasion? What do we know about the U.S. intelligence on this?
Well, certainly Putin is very, very astute at picking the moment. That's how he's looking around the world right now and saying, well, there's a bunch of reasons why I possibly could do this and I could even get away with it. And arguably, that big one is the US withdrawal from Afghanistan, and he would assess the US as being highly reluctant to ever intervene militarily in big conflicts overseas again. Equally, Europe is quite divided and arguing amongst itself at the moment, and also losing its elder statesman, Angela Merkel, the German Chancellor, who's leaving very soon after 16 years in power. And she was really the conduit between Europe and Russia. And in fact, she's called him twice this week, possibly to tell him to tone things down. But she's on the out. Then you've got, of course, distractions around Brexit and so on. So with lots of countries focused on other things and not perhaps willing to come in to defend Ukraine if needed, he might think that this could be an opportune time to do it. And the US intelligence and information is obviously concerning them enough that they're starting to raise the alarm, and to do so with their European counterparts and others. So certainly they've got something that's showing them that this must be a serious possibility.
Yeah, Roz, what is the state of NATO here? You and your team cover very closely the organization. Poland, Slovakia, Hungary, Romania, all bordering Ukraine, all NATO members. Is that organization able to respond at all?
Well, certainly can expect to hear warnings from NATO pick up in the next couple of weeks, because, of course, those countries that are on Russia's periphery, those Eastern European countries, have always been very anxious for decades about their position of being so close to Russia, and very much wanting the protection of NATO and welcoming the NATO presence in those countries. What you might see is a pickup, of course, in military exercises. We understand there are US warships again in the area. So you've probably seen some displays by NATO, by the US military, and so on, just to sort of show the Russians that they're there and they're very aware of what's going on, and they're watching things very closely. So you can see some signaling coming from the NATO group possibly in the next couple of weeks on that.
Roz, thanks very much. Rosalind Matheson covers international politics for us. Let's get down to Washington, D.C. Emily Wilkins joins us from the Bloomberg government team to hear what we can expect from the White House. Emily, surely President Biden has to comment on this and maybe even do something about it, because he can't be seen as weak, letting Vladimir Putin just take land if he wants it.
Absolutely, and you've already seen high-level U.S. officials weigh in on this. Secretary of State Anthony Blinken saying that the U.S. commitment to Kiev is ironclad earlier this week, and saying that the U.S. is very much on the lookout right now for any potential repeat of 2014 when Russia annexed Crimea. And they're keeping a very close eye on that. You saw President Biden bring that up in discussions with the EU Commission president early this week. You also saw that as a topic of discussion for Vice President Kamala Harris, who is currently in Paris. So this is something that's very much on the minds of the Biden administration, something that they are keeping a very close eye on to see what Putin does next.
Meanwhile, we do have in the United States not only the international questions, the domestic question of who will lead the Fed chair come next February. What's the latest on picking someone?
So there's still that giant question about whether Jay Powell will be nominated for a second term, or whether Biden will go with a more progressive pick in Lael Brainard. Both of them went to the White House earlier this week for interviews, talking with the president. There's also been some concern about Jay Powell and some stock trades that he did. There was a question of whether that might interfere with his nomination, but we're hearing now from White House officials that that is not going to be the case, that they are confident that his stock trades were done correctly and properly. There's still the big question at the end of the day is, can the nominee that President Biden puts forward pass the Senate? Remember, it needs at least 50 votes. You've already heard some senators like Elizabeth Warren say that they will not back Jay Powell for a second term, but you've also heard Republicans say that they will. So they might be able to get to 50 even if all Democrats aren't on board.
Yeah, Emily, I've certainly seen some analysis talking about the high inflation print and asking whether we need anybody more dovish to lead the Fed. Other analysis saying, look, it's a group decision when it comes to monetary policy anyway. Emily, thank you. Emily Wilkins of Bloomberg Government in Washington for us. Now, the COP26 summit is entering its final hours, and plenty is still left to play for. A new draft of the Climate Pact being debated today slightly softens language on asking countries to make deeper emissions cuts. Issues around phasing out fossil fuels and a global carbon market remain unresolved. Bloomberg's Maria Tadeo is live for us in Glasgow. Maria, good morning. What is still up in the air then for today?
Well, Anna, a lot is still up in the air. You know, we've been here for 2 weeks. This is the biggest climate conference in the world, but now today really is crunch time. We have a 6 p.m. deadline, local time, for this communique to come out. Now, you mentioned a number of things that are still pending. We know about the carbon market is still potentially a biggest, or could be one of the biggest breakthroughs to come out of this conference, but the wording around how to price and trade market in carbon is still very much up in the air. The question about fossil fuels is still up in the air. Remember, one of the key issues going into the COP was to remove explicitly any reference to fossil fuels, to say there should not be fossil fuels in the economy. Now, that is not featured in that way in this last draft that we had, but again, there's hours still to come on negotiations. And the other big issue is what to do with the targets, particularly China. There has been a number of voices calling on China to be much more ambitious on its targets to show that it's serious about climate change. So all of this up in the air, but again, as I said, there's still hours to come to this conference. The question is whether or not we get a communique that is seen as a breakthrough.
All right, Maria, thanks very much. Maria Tadeo there out of Glasgow with the wrap for COP26. It's been a couple of weeks there, and they've accomplished, well, she's telling us what they've accomplished, I guess. They could have done more, is what you'll hear from critics. Later this hour, we're going to speak with Dr. Raj Shah, president of the Rockefeller Foundation, and we'll ask him what they could have accomplished. It does look like a lot of critics think the richer countries are passing on just checks to poorer countries and not making the moves themselves in terms of cutting coal and combustion engine production. Let's take a look at some of the stocks moving in the pre-market this morning. AMC, the meme stock, moving, now accepting Bitcoin, Ethereum, Bitcoin Cash, Litecoin, and a number of other crypto coins, crypto tokens. Anna wondering how they're going to give change, and the answer is you don't pay with one coin or a half a coin, a quarter or a 50-cent piece. You pay exactly what your bill is, and it's going to be a very small sliver, obviously, of a Bitcoin just to go see a movie, which costs, I haven't been to the movies in the U.S. lately, but I'm going to guess like $12 or $15. Alibaba, also a big mover in the pre-market, or a big company that's moving, I should say, in the pre-market, down only 0.4%. But obviously, it's a behemoth, and it had a massive sales day on Singles Day, more than $85 billion in China's e-commerce holiday following a year of heightened regulatory scrutiny. This is one of the stocks that may move on feelings that could be plateauing. And then Beyond Meat, maybe catching a little bit of bid after a huge drop yesterday. It fell the most in a year after disappointing sales projections. They only expect $85 to $110 million in sales in the fourth quarter. The reasons are labor shortages, damages from Hurricane Ida, and it wasn't chips or supply chain, but, the Delta variant. So a lot of different excuses from Beyond Meat led to a huge drop yesterday, and investors may pick it up a little bit cheaper today.
Okay, I'm just very grateful for your explanation around how you use Bitcoin to pay to go to a movie theater. I was really concerned that they were going to be expecting you to pay $65,000 to go to the cinema.
Anna, it's
yes,
a great question. And it's not just, in other words, whether you get repaid in popcorn and Pop-Tarts. There is this question also, though, of how do you even value Bitcoin in real time to fractionally be able to pay for a movie ticket? Do you do it the night before the close of trading, or do you do it the next day?
No.
I mean, these are real
questions.
questions.
How will AMC do
These
that?
are questions,
Yeah,
the answers to which I know because I've used Bitcoin to do things like buy groceries, order a beer. I bought video games at GameStop with Bitcoin. The transaction is done in the moment for the spot price. It's trading 24/7, and you pay an exact change.
And now they have to work out how to value all this stuff on their balance sheets. It's a fascinating new world. And coming up on the program, we will talk about inflation hedges. There's a Bitcoin link there, isn't there? We'll talk to Suzanne Hutchins of Newton Investment Management. Does she think Bitcoin is the best way, or crypto, the best way to hedge against inflation, or is she still a little more old school and likes gold? We'll talk about that next. This is Bloomberg.
stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B. They're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now. Into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Lisa Abramowitz here in New York, Anna Edwards with us out of London. And I'm taking a look, we were talking about Bitcoin previously. Now I'm going to take a look at gold, the more physical, older commodity. You can see right here that we're coming off a little bit today, but we've had a really good week. In fact, we're up almost 2% for the week. I think this is, well, it depends how we close, obviously, but it's been the best week of the year so far. And Noor Al-Ali from our Bloomberg MLive team has been writing about gold because we also saw, Noor, a lot of inflation, right? CPI printed at 6.2% gain year over year. And historically, people use gold as an inflation hedge, or at least that's what we hear. And this week, that has proven true.
Yeah, absolutely, Matt. And that's an excellent chart to point out because historically gold has been the inflation hedge that we look at. And, you know, there were technical pointers that were really supporting gold. The 1834 mark, definitely for gold, has been something that these watchers have been watching very closely. So the fact that we've hit there has just meant that it's going only up for now.
Inflation, a big theme of the week, and good morning to you, Noor. We've seen, of course, Treasury markets really react to that higher yields. And Lisa was asking a very valid point at the beginning of this hour. Why are we not seeing more negative reaction from the higher yield environment that we have this week in stocks? Because we have seen that in the past. We saw that maybe earlier on the week with Nasdaq, but there was a lot going on with Tesla and Elon Musk and some other stories. So why are we okay with this rise in yields right now for stocks?
I don't think we're okay with it, but that's this really good framing there because I think what we're seeing in the stocks market is we're rotating out of the bond market. And if you're looking at your options right now, there aren't as many out there. It's inflation hedge roulette right now. So people are trying to see where can they come and get their best value for their money. So you see the bond market traders pricing in more tightening policy from Fed and policymakers across the globe. But I think the stock market is still weighing in these factors.
Okay, Noor, thank you very much. Thanks for joining us, Noor Al-Ali of Bloomberg Markets Live. Remember, you can get further market analysis. MLIV Go is the function to use on your terminal. This is Bloomberg.
common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector, in Scotland around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Lisa Abramowitz in New York. And now let's get your first word news. In China, senior Communist Party officials say the country has reached a new, quote, historical starting point led by Xi Jinping. Top leaders have paved the way for the president to rule indefinitely by signing off on the first historical resolution in 40 years. Officials say Xi's new doctrine on party history didn't focus on past wrongs because those have been settled in past documents. Oil is heading for its longest run of weekly losses since March. President Biden is keeping investors guessing about whether he'll intervene to hold down prices that have hurt consumers. The price of gasoline in the United States has hit a 7-year high. The president is considering a number of moves, including a release of oil from the Strategic Petroleum Reserve. And the labour market is tightening up in the UK. More than 220,000 job advertisements were posted in the first week of November, according to the Recruitment and Employment Confederation. That's the fourth highest since the start of 2020. Driving instructors, prison officers and forklift truck drivers were in increasing demand. Coming up on the program, Suzanne Hutchins, Newton Investment Management Head of Real Return, and we will get back to our conversations around crypto and what kind of inflation hedge they really provide. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Lisa Abramowitz in New York. Kayleigh Lyons is off this week. And Lisa, you were raising this question earlier about why we're not seeing more fallout in equity markets from the higher yield environment. And certainly through the Asia session, it seemed as if Asia investors really happy to digest some of those higher yields. We saw Asian equities moving to the upside, but there were some other China lines that perhaps they were trading around. It is an interesting question, though. How comfortable will equity market investors be if we see a continuation of this higher yield story?
And it's not just an absolute level. We're also talking about volatility, implied volatility in treasury yields rising to the highest since the peak of the pandemic, and yet you are not seeing any sort of similar reaction in the VIX and the gauge of volatility in equities. Why this divergence, and how long can it continue, Anna, especially as the Fed moves closer to normalization?
Yeah, and Matt, the European equity markets, the absence of volatility, I suppose, today, at least at the aggregate level, the stock 600 going absolutely nowhere.
Yeah, which is interesting because we saw such big gains in Asian markets on the back of, I guess it's because that was on the back of tech, and there's not a lot of tech trading in Europe. Take a look at the stock 600 right now, completely unchanged, really, at 485. S&P futures aren't doing much better, although they're gaining about 1/10 of 1%. Interesting to note, the S&P yields 1.27%. So treasuries are doing better by about 30 basis points right now. U.S. 10-year yields, we just saw with Lisa, 157.67, coming up a little bit as investors let go of that debt, and Bitcoin coming down 1.5% at 64,077 right now. I think the pre-market is pretty interesting in terms of the stocks that are moving. I've been watching Rivian, obviously, very closely. I think a lot of us who are interested in the electric pickup truck have been, as well as big growing companies. I mean, now it's worth $108 billion because people think it might be the next Tesla. You can see in the pre-market it's up a little more than 3%. NVIDIA is one I've been watching very closely. This stock has absolutely killed it. Year to date, I think it's up 130%, and NVIDIA is getting a price target increase at Susquehanna. Now it's up 1.25% in the pre-market to 307. Farfetch is actually a London-based company, but it trades over here on the NASDAQ, and they're going to buy the Net-a-Porter business, or the stake in Net-a-Porter from Richemont. That leaves Richemont investors feeling relieved. Farfetch investors are excited about it, too, because it's going to be an industry-wide platform that they're building. And then 23andMe, right now it's down 7% in the pre-market. Caught my eye because it's the biggest pre-market loser with a market cap of more than $5 billion. but it had a 13% and change gain yesterday after earnings, and Citi said next year is going to be a much better year for 23andMe. Certainly, hopefully, it's better than today. Anna?
That seems like some volatility there. Matt, let's think about where we are on inflation. Been thinking about inflation a lot this week, given the PPI numbers out of China, the numbers out of Japan and Japanese factories, and of course the consumer story out of the United States. So it's been a real focus for us all of this week. So where is the best place to find that inflation hedge? We talked to Noor Al-Ali, our colleague on the Markets Live blog, around gold, and that typically is seen as quite an inflation hedge. But increasingly people talking about Bitcoin, of course. And here we've got Bitcoin and its strong ties to inflation, and its strong ties to inflation expectations. We have Bitcoin up against break-evens on this particular chart. And I just wanted to go back in time and show how maybe some of that correlatory relationship has increased just in the last couple of years or so. And I wonder what Suzanne Hutchins over at Newton Investment thinks about this as an inflation hedge. Suzanne, good to speak to you, head of real return at Newton Investment. So when you're looking for real returns and you're looking for something that cuts through that inflation story, protects you against inflation, are you increasingly dipping your toe into crypto? Are customers and clients talking to you about crypto much more?
Morning, Anna. Yes, I mean, obviously crypto is a major topic amongst all of our clients and investors. We currently are not invested in crypto. Personally, from my point of view, I feel as though there needs to be some more history behind how crypto actually works outside of the banking system. But I certainly think that it provides a diversifier in a portfolio and an alternative currency. And obviously there are lots of ways in which you can access it, but owning an ETF in crypto is one of them. But the carry trade around that is quite expensive. I mean, my personal view is that equities actually provide one of the best inflation hedges in your portfolio, which is why in the real return strategy we've got a significant proportion to equities right now.
What do you think about the yield? We've been talking about this past couple of days. On the S&P 500, it now takes, I think, 79 years to pay back your principal with the paltry yield you're getting, and it's even lower than treasuries. Is that a concern?
Well, all asset prices across the world are very, very elevated, so including that of the US index. We don't invest in indices, so it's very much down to the individual stock selection. So getting that right is absolutely key in this environment. And particularly when there is more price inflation around, you do want to be in the companies that are able to pass that inflation on to the end consumer, and those that are in a dominant market position with brand power as well.
It's interesting to see the gains now at 31% over the last year. I think if you look year to date, we're seeing about 27%. Last year, about 17%. The year before that, 29%. How much longer can this continue?
Well, we've just gone through the earnings season, which actually has been pretty decent. And obviously, the market is very data dependent. And I think there's going to be a lot of volatility in the marketplace. So whilst we have got significant exposure to risk assets in the portfolio, our promise also to clients is to help reduce volatility and preserve capital. So I think it's very important, even if you've got a constructive view about the economic backdrop, about the earnings outlook, that you have preservation, direct protection in your portfolio, whether it's through derivatives or high levels of cash, or alternative types of strategies which will help to mitigate some of the downside in markets. And for example, we actually have absolutely no developed market government bond duration in the portfolio because we think that's an area that is still at risk.
That's fascinating, Suzanne. I wonder if we could extrapolate out whether you see that as a potential risk to U.S. equities that are heavily dominated by the big tech names. Are you getting a little bit more bearish on the U.S. stock complex versus, say, Europe, just simply because of the policy divergence?
Well, I think it's very difficult to just generalize, just because individual companies make their profits, anywhere across the world, and their cost base is very disparate as well. So just because they're domiciled in the US doesn't necessarily mean that their sensitivity is to the US market. But that being said, you're absolutely right in terms of the way the index is composed, much more tech heavy in the US. And I still think there's massive opportunity in those securities, whereas in Europe, for example, it's much more bank heavy. Again, in an inflation environment, we have increased over the last 12 months our exposure to financials, not necessarily Europe, but certainly in the US. Because obviously financials benefit from net interest margins widening. And so, they're a very good way in which you can place your money in terms of a higher interest rate environment. And also commodities as well.
Yeah.
So you've really got to be stock selective in our view.
Suzanne, if you are, though, chasing a policy divergence, I wonder how much China actually looks fantastically attractive, considering they are now looking at possibly easing policy in the face of some of the home developer turmoil. What do you think of China right now?
I think China's an interesting one because, the growth rate for next year, I think is, destined to be around about 4.7%, having been well above 6%. Historically and even more. And, I was talking to a specialist today on China and, 50%, the Chinese economy is very much dependent upon residential and construction. So it does really depend upon how strict these measures get put in place. And then, is there any further easing beyond that? I don't think policymakers are going to want to, have China implode. But certainly there's going to be, some quite significant measures that take place, along with, obviously, their commitment to climate change, which will also be quite instrumental to their growth prospect.
Suzanne, thanks for joining us. Good to speak to you. Suzanne Hutchins, Head of Real Return at Newton Investment Management. Coming up on the programme, Dr. Raj Shah, President of the Rockefeller Foundation. We were talking tangentially around some of the COP themes just there with Suzanne. She was referencing climate change. And we'll certainly get into the conversation with Dr. Raj Shah around what we've learned from COP26 and the impact, the achievements and lack of. This is Bloomberg.
Compared to other search engines. We use the money to plant trees all over the world where they are needed most.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The world knows what a mess our planet is in.
Despite the progress that Paris represented, most countries have failed to meet
the action plans that they set 6 years ago.
The Biden plan is to diversify and to make sure that we move in a direction of clean energy where we're not reliant upon cartels and we're not reliant upon geopolitical adversaries.
For any government, it's not as simple as flicking a switch. There are careful transitions that need to be done.
Human beings created this problem. Human beings can solve it.
Some of the highlights there from world leaders speaking at COP26 as it draws to a close today, or perhaps over the weekend. Looks as if things could overrun in Glasgow. Joining us now is Dr. Raj Shah, president of the Rockefeller Foundation. He served under President Obama as the administrator of the United States Agency for International Development. Dr. Raj Shah, really good to speak to you. Thanks for joining us. I think you're also involved with the Global Energy Alliance for People and Planet, hence your involvement with the COP26 conversations and negotiations. What is it that your alliance brings? We've covered a number of alliances throughout the last 2 weeks in relation to COP26. Mark Carney's GFANZ, that's got a lot of attention because, of course, of our emphasis on the role of finance here. So what does your alliance bring?
Well, really, this alliance is grounded in a very simple idea that for the first time in history, renewable energy technology makes it possible to reduce carbon emissions while increasing opportunity for people who live in developing countries. There's still more than 1 billion people on the planet who have no access to electricity whatsoever and live in the dark and therefore live in poverty. So we announced a $10 billion alliance, including commitments from partners like Rockefeller, the IKEA Foundation, the Bezos Earth Fund, and development banks around the country, around the planet, really, to reduce carbon emissions by 4 billion metric tons over 10 years and reach people who do not have access to electricity, but to do it with renewable electrification as opposed to coal, which is the path that most countries are on right now. So that's really what we announced. And unlike some other announcements, all of which are extremely well-intentioned, this is already active in more than a dozen countries around the world. We've shown real concrete results. We have co-investors, and we are expanding this in a very accelerated way because the time to act is now.
And give us a sense of just how scalable and affordable those renewable energy options now are versus history, Raj. For those who maybe are still wondering whether this really can be the future, can be the solution without coal, without oil, without the things that we've typically always fallen back on.
Well, this can be, and frankly, it just absolutely has to be. Our programs in India are able to reach already about 800,000 people, providing solar energy to deep rural communities at maybe 20 to 22 cents a kilowatt hour, which is 1/3 the cost of diesel generators, which is what most of those families and businesses use without access to this. And they're still waiting for the grid to connect them to coal plants that are producing at a lower price, but are simply not available, accessible. The same math applies in Nigeria or the Democratic Republic of Congo. In Colombia, where we're active, we're both expanding access to populations that live on the borders of Venezuela and elsewhere, but also helping them improve the grid by putting battery storage and other strategies to improve the ability for the grid to take renewable energy. So in country after country, there are opportunities to transform the way we provide electricity and opportunity to people. And this alliance will be on the front end of providing that with public-private resources and new technology.
What has been, you think, the most encouraging thing we've seen out of COP26?
I think it has been these new public-private collaborations. I mean, I think COP for, decades of meetings has been very public sector. It's been a lot of making commitments. Often those commitments, like out of Copenhagen and Paris to provide $100 billion of transition support to developing countries, have simply not been materialized or have not been met by wealthy countries. So now you're seeing a slightly different approach with real public-private collaboration, the setting of targets, the measuring of results, and the expenditure of real resources. And that I think will be the future.
Do you think, have we seen enough that leaves you confident we'll achieve the goal of limiting the increase in temperature to 1.5 degrees centigrade?
Well, no, of course not. But I do think, the world is better off with COP without it. It's a place where people go, make commitments, are held to account by peer pressure from heads of state, heads of corporations, heads of banks. But progress is still too slow. We're, experts estimate we're on path to get 2.7 degrees, not 1.5 degrees. We still haven't met this $100 billion commitment number that's been out there for a decade. And the public-private efforts like ours are important contributions, but they're no substitute for public investment as well. And so we need to see kind of follow through on the commitments made at the Glasgow COP if we're ever going to change off that 2.7 path and get down to something below 2.
Yeah, my understanding, Raj, was that, yes, before this event, the events of Glasgow, we were on the path to 2.7. I think the IEA ran some numbers and suggested that if you include everything that's already been pledged at Glasgow, maybe we're heading for 1.8, which isn't 1.5, but it's closer. What difference does that make to the world, though? The difference between 1.5 and 1.8, explain that to us.
Well, it's tremendous. Every little bit of achievement actually dramatically reduces the risks that sea levels will rise and wipe out coastal populations across the planet. By the way, the most vulnerable populations are those in developing countries. Those that are already poor and suffering are the ones that are most likely to suffer more with climate change in the present and the future. It reduces the risk that we'll lose 30% of our crop production in places like Africa, Asia, and Latin America, warmer tropical climates where crops are more vulnerable to hotter, drier growing conditions. It dramatically reduces the risks of sort of irreversible rapid ice melt that has other weather and other types of consequences in addition to rising sea levels. So it literally gives us a vision and a path to potentially protect humanity and protect our planet. The issue isn't really the commitments. The issue is the execution and the follow through. And I think that's why I think these public-private collaborations are so important. In our case, we're putting real money on the table, we're spending it, we're reporting on results, as are our partners. We need that mindset to be pervasive across the public governments that are making the kinds of commitments that could get you from 2.7 to 1.8.
Raj, thank you very much for joining us. Dr. Raj Shah, Rockefeller Foundation President, with his thoughts on COP26 as the talks there continue today and probably into the weekend. Now tonight on Bloomberg, Wall Street Week with David Weston wraps up the week in markets, from General Electric's breakup to former U.S. Treasury Secretary Larry Summers' reaction to the U.S. inflation data. That is tonight at 6 p.m. New York time, 11 p.m. in London. This is Bloomberg.
His top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lyons is off this week. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now with a look at what's ahead. And Tom, I think you're focused as well on consumer sentiment. I hesitate to say which college it comes from, but it's up north of Ohio.
It's up north of Ohio, out of Ann Arbor, with decades and decades of experience of doing this, University of Michigan. And Matt, this is a different view than the normal Michigan numbers. This is the view, the guesstimate of the public's view of inflation out 5 to 10 years. It's a stunning chart from 40 years ago. Down we go off the Volcker inflation. And the band here is between 2 and 3%. And we are just now beginning to ebb up with 5 to 10 year inflation expectations to the 3% line that Adam Posen of the Peterson Institute and select others are talking about. I bring this up because next week we are efforting Olivier Blanchard, who this morning put out a blistering note on America and its inflation. And Matt, this chart sort of describes a tension of getting near the Posen line.
Absolutely, really important to get that long-term perspective, or very useful to get that long-term perspective, Tom, good morning, given our experience of such low inflation relative to history in years and years and years before this. Tell me about the psychology of some of the things that are feeding in here. We heard from the Biden administration just recently about how the spending plans, they want to cast them as not inflationary, but of course others would point to infrastructure spending as having been inflationary in the past. How does that all weigh in here?
It's a political debate, but what I would suggest, what is really important, Anna, and the distinction, I don't know if it's true in the United Kingdom, but the distinction here is the breadth of higher prices seen in this week's inflation reports. It's not about rent, it's not about used cars, et cetera. It is the breadth of the lift in inflation, which not only has the politicians, but also Wall Street pros, it has their full attention.
All right, very interesting focus, Tom. We're looking forward to your program. Tom Keene, co-anchor of Bloomberg Surveillance, which is coming up next. One of the things they'll surely discuss is the threat of Russia in Ukraine. At least that's what the U.S. has reportedly warned Europe about, saying that Russia is amassing troops on the Ukrainian border and may soon invade the country. The interesting thing, Anna, I think, is that they have given Europe this assessment, but they haven't reportedly given Europe the information on which it's based. So they need to share that information, that intelligence, before any kind of collective response could be put together.
And this obviously comes at a time of real tension between Belarus and Europe, and Belarus very vocally backed by the Kremlin, backed by Russia. So that will be important to see. I'm also watching the events at COP26 in Glasgow, supposed to finish today, will likely run into the weekend. Really interesting, I think, from a market perspective to see what kind of commitments we get on Article 6, that's carbon trading, but also the transition. To what extent is it going to be front or back loaded? That, for those in the markets looking out over the next 5, 10, 20 years, is going to be really important. That is it for the early edition. More Bloomberg Surveillance is ahead. We'll hear from Chris Verone of Stratagas. This is Bloomberg.
engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Inflation is going to be getting worse before it gets better.
The Fed isn't going to make any presumptions about how the future turns out.
I think the Fed's job here is to be the steady hand and keep their eye on that medium term.
This is a new Fed, it's a new reaction function, and they are willing to let things run hot.
Everything is transitory in a long enough time frame.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Wrapping up your trading week from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market futures up 7 on the S&P, grinding higher by 0.1%. On the week, though, Tom, heading for the biggest weekly decline in about a month.
Well, some of the tensions that are out there, and what it is Tea Leaf Friday, John. I'm going to anoint it right away as we're all struggling to look at tea leaves. We've got great guests to help us with the tea leaves. The immovable force in the room. And John, this goes to some of the politics of the last 24 hours. Weak euro is an elegantly weaker euro chart.
We could talk about U.S. politics a little bit later, Tom. There has been an Anne-Marie sighting in New York City. She has arrived. We'll catch up with her in about 10 minutes' time. In Europe, Tom, you mentioned Europe. Bank of America, negative on European equities, looking for 10% downside in the near term and calling it the anti-Goldilocks combination of weaker growth and rising real bond yields to weigh on European equities. Just one of the calls out there this morning, Tom.
And maybe it's a calendar item, John. It's getting a little chilly here, a little bit of Arctic cold coming into Minnesota, maybe and over. And it's the same thing in Europe. It's a sum total of a Europe subsiding. What does that mean for anybody, including Chairman Powell? We can't forget the Fed Derby right now.
That's the European situation. Stateside, we reopen the bond market. Treasury yields are higher on 10s by 3 basis points to 158. And this Treasury market, Lisa, has been totally whipsawed from the moves last week compared to the moves this week.
And the expectation is for that to continue. If you take a look at the Bank of America Merrill Lynch Move Index, basically the implied volatility in Treasury yields has risen to the highest since the height of the pandemic. Here's my question of the week, frankly. Why are stocks not responding more to some of the volatility that we're seeing in bonds and to the rise that we've seen in short-term yields, especially if strategists do not think that the rest of the world can handle the U.S. going it alone?
Any Fed speak today? Have we wrapped that up?
Nope, John Williams is speaking.
Mr. Williams of the New York Fed a little bit later. Let's get some price action before Lisa runs you through the day ahead. Your equity market up a little more than 0.1% on the S&P. Veterans Day yesterday, so the U.S. bond market was closed. We reopen and resume the climb. Yields are higher by 3 basis points on 10s to 157.84. Higher on the front end as well by 3 basis points to 54 on 2s. We'll touch on that a little bit later. And crude, Tom, is down for another week, a third straight week of crude grinding lower. the longest such streak going all the way back to March of this year. WTI 80.21.
I'm glad you bring it up. And that I looked at the chart this morning, John, and it is an ebb away. As you say, it's a grind lower. I really don't know what to make about it, other than, as we just talked to Anna Edwards about, the sum total of inflation seems to be the lesson learned this week. It's not just about oil or just about rent. It's the sum of our inflations.
The euro a little bit weaker. Euro dollar negative 0.1%, Lisa. Euro dollar 114.42.
Yeah, and we've been talking a lot about policy divergence, and frankly, that has been the theme of the week between the U.S. and Europe, and even in China, which is going in the opposite direction and actually easing policy. Today, what I'm watching is the idea that President Biden is going to be participating in the Asia-Pacific Economic Cooperation Leaders Meeting. The idea here is that the pandemic is an economic issue globally. The idea that we've got a zero COVID policy in China that's hampering growth, and how do other nations deal with that, especially the U.S. that relies on China for some of the supply chain issues at a time when their GDP over on the East has been declining. Then at 10 a.m., Tom has been talking about this all morning. We're going to be getting the University of Michigan sentiment survey. The expectation is for it to actually firm a little bit from the lowest levels going back to 2011. But what I'm interested in is the 5-year inflation expectation. This has been rising pretty significantly. At what point does this start to bleed into consumer expectations? We're also going to be getting the JOLTS data, the job openings, and I'm curious to see how much that continues to go down. In other words, is this labor market getting less tight? Are we, or rather less loose? Are we starting to see people fill those roles that have been posted? And then later today, 12:10 a.m., New York Fed President John Williams is planning to speak. Of course, everyone's looking to see whether he has anything to say about the potential leaders of the Federal Reserve, Jay Powell, Lael Brainerd. Still haven't heard which of them we are going to be getting, John.
Lisa, thank you. On the Fed speak, want to look out for a little bit later. I just want to get to a note that just dropped from Wells Fargo. More hikes in 2022. They fold, Tom. They look for a move in Q3 of 22, another move in Q4 of 22, and 2 additional rate hikes of a similar magnitude over the course of 2023. That note, Tom, just getting published moments ago.
No, it's a setup for the weekend. And the answer is on this Friday, John. Everybody, I believe very strongly on the calendar, November 15th-ish, that we are resetting this weekend for the guesstimates, not so much into December, but really trying to frame out Q1 22, and it starts today.
And at many houses, those hikes are getting pulled forward. Chris Ferrone joins us now, head of technical and macro strategy at Strategas. Chris, a couple of things I want to talk about. You're really focused on one thing, though, and I want to start there. This curve is flatter. Small caps are near all-time highs, and many people are asking a question. I know they're asking it of you. How can we have this re-acceleration in the cyclical trade at the same time that the curve is flattening? Chris, what are you saying to people?
Yeah, it's a great question, John. And when you look at the resurgence in some of these cyclical parts of the market, whether it's small caps or semis or discretionary industrials, it seems to be difficult to reconcile that with the shape of the curve. We've gone from 2s and 10s at 130 wide a couple weeks ago to 2s and 10s at 100 pips today. And what we did this week, we dug in and we looked, okay, we're about 20 months off the March 2020 market low. At this point in a cycle, what is the curve typically doing? So we went back the last 50 years, and believe it or not, by about 1.5 years off a low, the curve is tending to start to flatten by this point anyway. So what we're seeing, this cyclical leadership with the curve flattening, while it feels unusual, is historically not that uncommon.
Chris, does it seem odd to you at all that we're seeing some significant moves in the front end of the yield curve and not significant moves in the broader equity market?
Well, we always think about the 2-year yield in context of the Fed funds rate. And I would frankly be more uncomfortable if 2s were going the other way. Like the macro signal of 2-year yields trading above the upper bound of the Fed funds rate actually still says you're more early to mid-cycle, not late cycle. When you get to that late cycle environment, it's actually when you get bull flatteners, right? So curve flattening because 2-year yields are falling. I think that would be a more troubling setup than the current one. I also think, as John kind of hints at, the equity market is really not taking its cues off this. When you look at the leadership profile of this market right now, financials have held up great. We're seeing more cyclicality from groups like industrials, basic materials have acted a bit stronger here again. So I think at the margin, the market is telling us that, hey, this economy might actually be re-accelerating, and 1 or 2 Fed hikes in 22 is not going to derail that.
Buried in your note, Chris Ferrone, is what everybody's talking about, which is how do we get out 65 months? You talk about the distance out there. On a technical basis, as you draw the vectors of support and resistance around whatever we're talking about, what's your confidence out 65 months?
Well, I think everyone's confidence out 65 months should be close to zero, right?
Thank you.
No one's a great forecaster of that duration. What I think is kind of more important when we look at that study, and what we were really talking about is by the time the curve starts to flatten, on average,
right,
you had about 4 to 5 years before the curve ultimately inverted. And that's what's really important about yield curves. There's so much noise in the curve until it's inverted. That's the signal. And we were just simply making the case a flattening curve is not an inverted curve, and a bear flattener is not as damning as a bull flattener. So I think we have some time here. I know it's where all the anxiety is. We prefer to take our cues from the equity market here. I think the equity market is screaming that economic growth is actually getting better here, not getting worse.
Well, this goes, I want to set up the gloom crew that love to write on Friday and go gloomy through the weekend, and I want you to push against them. And let's take it back to Earl Blumenthal in 1949, A.W. Cohen, and point and figure charts. Blumenthal tried to measure cathartic events. Do you see the speculative forces right now that indicate cathartic events now or in the near future?
I think over the last couple weeks, this has been a market that has gone from a pretty cyclical bias, maybe the last month or two, to starting to show some signs of excess speculation. We see it, perhaps with Exhibit A, the new high in Bitcoin, or we see it with the improvement in some of the SPACs, or some of the publicly traded private equity firms are all making new highs. So there are some of those signs of maybe excess speculation or excess liquidity out there. I don't think that's a very important signal at this moment. We've never had any success making a sentiment call in November or December. The seasonality is just too strong. I think if you start to look out to 1Q or maybe 2Q, there may be a moment where we're going to have to make a sentiment call. Okay, things are running too hot. There's too much speculation. Let's position for some type of a setback. I think it's early to make that call yet, though, Tom.
Chris, always good to catch up, sir. As always, Chris Ferrone, strategist there on a view forward for this equity market. Here's the view forward for this economy, stateside. Just working through this Wells Fargo note, Tom. Look at this for an inflation forecast. We look for a 5.2% annual rise in the CPI during 2022. That's for next year, Tom, a 5 handle through next year at an annual rate of 5.2%. The call from Wells Fargo. And I think it's important, once you get someone's inflation call, ask them what their GDP call is as well. GDP, real GDP to rise 4.1% in 22, 3.3 in 23. And this is the point that you're making, Tom. Inflation with a 5 handle might get people concerned, but Tom, real GDP with a 4 handle through next year too. Maybe that's what some people in this equity market want to see.
The giant Philip Carre living to, I believe, John, 104. John, can you imagine me 104, you and I and Lisa still doing
I can see you still doing this show,
Lisa will still have she'll have her first gray hair by then. But John, I look at what Phil Carre said, and it's the bright lights of inflation. Do the math, folks. 5% inflation plus whatever John wants to put on GDP. You're talking an above China American growth.
They're the kind of trades, Lisa, that some equity bulls, I stress some, would like to take.
The issue to me is still real wages. At what point do we start to see that become a real significant issue, especially because of the bifurcated recovery in the population?
What a difference a CPI print makes. What a week we've had already. Wrapping up the week and sending you into the weekend. We'll be catching up with 7 a.m. Eastern Time with Jean Bavin, the head of the BlackRock Investment Institute. Looking forward to that in about 50 minutes' time. Your equity market up a little more than 1/10% from a beautiful New York City this morning. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A warning from the US on Russia. Bloomberg's learned that Washington has told the European Union that Russia may be considering an invasion of Ukraine. The US has been monitoring a buildup of Russian forces on the Ukrainian border. All this is occurring as tensions flare between Russia and the EU over energy supplies and migrants. Russia says talks of an invasion is unfounded. In Japan, the government it reportedly is coming up with an economic stimulus package of more than $350 billion, according to the Nikkei newspaper. The package will include benefits for those 18 and younger. Japan's economy is forecast to have slipped back into contraction in the quarter that ended in September. And in China, senior Communist Party officials say the country has reached a new, quote, historical starting point led by Xi Jinping. Top leaders have paved the way for the president to rule indefinitely by signing off on the first historical resolution in 40 years. Officials say Xi's new doctrine on party history didn't focus on past wrongs because those had been settled in past documents. The US is joining with China and Russia in urging the Taliban to cut ties with terrorist groups and stop them from operating in Afghanistan. That's after a recent series of attacks in the region. 3 countries plus Pakistan agreed to continue what was called practical engagement with the Taliban. The iPhone assembler Honhai posted quarterly earnings that beat estimates. Profit was boosted by strong demand for new devices from Apple, its largest customer. Still, the Taiwanese company warned that sales will decline this quarter because of the shortage of semiconductors. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
I was just finishing what you were saying, Tom.
Thank
November
you.
3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now into weakness. Is this where they play the music in the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
veterans represent the best of America. You are the very spine of America, not just the backbone. You're the spine of this country. We're going to work with Congress, Republicans and Democrats together to make sure our veterans receive the world-class benefits that they've earned.
The President of the United States on Veterans Day. From New York City this morning, good morning. Tom Keene, Lisa Braberts and Jonathan Ferro wrapping up the trading week with equity futures up 7, advancing a little more than 1/10% on the S&P 500. The bond market was closed yesterday. It's open today with yields higher 3 basis points, approaching 160 on 10s at 158. And if you want a single name, here it is. J&J in the pre-market looks a little something like this, with reporting from Dow Jones indicating the following, Tom. I'll read the lead paragraph verbatim. Johnson & Johnson planning to break up into 2 companies, splitting off the $15 billion a year division that sells Band-Aid bandages, Tylenol, and Johnson's baby powder, in a shift indicating just how much healthcare has changed since the company helped pioneer the industry. TK, that stock is up in the pre-market 3% at 168.
I can't emphasize enough, John, how this is not General Electric. They are 2 names, and clearly they're associated together. And yes, J&J has been buttressed by healthcare doing better. J&J with a 10-year return per year of 12.8%. John, this is not General Electric.
It is a big company, $429 billion, Lisa. And when news like that drops, naturally people ask, who's next?
Yeah, and also the idea of what has changed for the pharmaceutical industry. Is it all of a sudden more reliant on some of the financing that it got previous following the pandemic, that it can be more steady and doesn't need the offset of the ballast of the slow-moving consumer products business?
The market just taking in that news, processing it, the stock up by a little more than 4% at 170 in the pre-market. The news from Dow Jones, Tom. Johnson & Johnson planning to split into 2 public companies.
Now, we talked about this last week. I thought our coverage, John, I was really proud of our coverage on General Electric, and it does start with the financial integrity of a company. Of course, J&J, decades back, like all of pharmaceutical, absolutely bulletproof. They've had their challenges. They've really rebounded nicely. Again, that double-digit return is acceptable. I'll get it out, John.
You'll get it. 3, 2, 1.
There, got it out.
Happy Friday.
Well, yes, thank you. To Wall Street, but John, I just can't emphasize enough. This seems to be the trend, and I'm sorry, it's CFOs like lemmings off a cliff. They're all going to deconglomeratize.
I'll try and get some Southside reaction to that call, Tom, in just a moment. 168, stocks up about 3%.
CFOs off a cliff was a great album.
That was beautiful, Tom. Beautiful.
I just loved what Flock of Seagulls did with that.
The CFOs around the world will love you for that.
They did. Come on, they're all looking at GE going, what do we need to do like this? What's Larry Culp drinking that we need to drink as well? And here we are 1 week later with J&J, boom.
I imagine that J&J's effort here, Tom, has been in the works for a while, and they didn't just respond to the GE news earlier in the week, but I accept that there's a trend evolving
here.
But
we're coming out of the pandemic as well.
Looking around the world and thinking about what this company needs to look like in the future.
Should we move on while we see J&J move?
I think you should,
Let's do that. Emily Wilkins with us from Bloomberg Government. We're thrilled that she could join this morning. Emily, what does a president's weekend look like? I mean, it's sort of a blur here, and there's an event and all that. He's going to sit in the study at the White House and think about something. What's he going to think about?
Well, he's got a lot to think about because there's a lot coming up in Congress. I mean, number one, inflation absolutely has to be on his mind. The high numbers this past week, highest in 31 years. And you saw that immediate reaction from Senator Joe Manchin saying, look, this is a big concern. It's been a concern for Manchin for a while. Biden's got to be thinking about that. Oil prices, that's another thing. We know a small group from the White House has been meeting on that, debating should they tap in to that strategic reserve? Should they wind up banning exports? Should they wind up changing regulations so it's a little easier to put crude into gasoline? And the other thing is that next week, the House is back, and next week is the week that moderates promised progressives that they would take a vote on President Biden's signature social welfare and tax legislation. So that's got to be lots and lots of things for the president to think about this weekend.
The Fed chair race is going to be another one of them. Emily, let's talk about it. A little bit of news from Bloomberg in the last 24 hours about what might hold back the chairman, what might not hold back the chairman from getting another term. What have we learned?
So there was a bit of a question whether some of the stock trades that Jay Powell made back in October of 2020, he traded about $5 million in stocks. And there was a question, was that something he should have done? And the Fed has come out, said, look, it's all above board. He went through the ethics. Everything's totally fine. But there was a question about perceptions. And now we have, Bloomberg is reporting that White House officials are saying, no, that's not something that we're concerned about when it comes to Jay Powell. And when we're looking at this nomination process, Biden has said that he would like to get a nominee out there soon. And there's still a question whether he'll be going with Powell, whether he'll be going with Leah Bernard, and what that's also going to look like in the Senate. Because remember, you need those 50 senators to approve any nominee that President Biden puts forward. And you've already heard concern really from around both individuals.
Emily, inflation very much the backdrop here. What would President Biden want from a Fed chair, a more dovish or a more hawkish leader of the central bank?
So the interesting thing here is that when it comes to dovish and hawkishness on the issue of inflation, I mean, Powell and Bernard, they're pretty similar in exactly what they would do. And so it seems more of a question when you hear from senators, when you hear them talk about this, about regulation, about where either stands on regulation, on how strict they would be on big banks. I think that's going to be a bit more of a moving point for senators as they consider what's going to be happening next. Although certainly, I mean, like I said, after the inflation numbers, you're absolutely right, Lisa, to point out inflation. That is something I think that is really on all lawmakers' minds in D.C. at this moment.
Emily, thank you. Emily Wilkins down in Washington, D.C. on the latest, including the latest on the race to be the next Fed chair, which we don't have much news on whatsoever going into the weekend. Maybe we will a little bit later. I've got no idea. Want to touch on that story again in the pre-market from J&J. The stock is up by almost 5 percentage points now, through 170 in the pre-market. Dow Jones reporting the news that J&J is planning to split into 2 public companies. There's an interview in the story with the CEO, Alex Gorski, Tom, about this decision. They decided to make the change, he said, because the businesses, their customers and markets have diverged so much in recent years, including during the pandemic. And this is going to be the key line for a lot of people, Tom, who naturally will ask this question. According to Alex Gorski, lawsuits that allege the use of Johnson's baby powder caused cancer did not play a role in this decision. There will be, of course, Lisa, a lot of people this morning asking that particular question.
Right. How much are they just trying to immunize some of the liabilities on that side while allowing their pharmaceutical business to absolutely surge the way you have seen with Moderna and other pharmaceutical companies? Regardless, the change, I wonder how much of it stemmed from the pandemic and from their preeminence or lack thereof in certain developments of technologies, right? Do they want to refocus on mRNA kind of technologies going forward?
It's going to take 18 to 24 months to shed its consumer division. So this is going to take a while, Tom. And here's the PR quote that I know you love and always look for in any statement. The best path forward to ensure sustainable growth over the long term and better meet patient and consumer demands is to have our consumer business operate as a separate healthcare company.
We're just going to have to see. What I would say, John, again, this is a sterling company. I just looked at the weight of debt, the debt percent between GE, and these are 2 separate worlds. GE with 36% debt, as Culp tries to save that franchise, and Johnson & Johnson on the edge of AAA, on the edge of Amazon, with 7.4% debt. Yes, the lawsuits are tangible, but I just think this is the future, John, a deconglomeratization.
In the pre-market, the stock is up by a little more than 5%.
Who's next?
Who's next is the question a lot of people will be asking, Tom. From New York, on radio, on TV, this is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
3 hours away from the opening bell this Friday morning. Good morning to you all. Your Friday morning price action shaping up as follows. Futures advanced by about 0.2%, up 8 on the S&P 500. On the Nasdaq 100, up about 0.2%. Coming into Friday, Monday through Thursday, the S&P 500 heading for its biggest weekly loss, going all the way back about a month or so. Just a little bit of a movement in time. You can call it a cratering if you wish. In the bond market, absolutely whipsawed week to week. So last week, you had a 10-year yield that came in about 10 basis points. This week, it's up about 12. On a 2-year, the 2-year came in about 10 basis points. This week, it's up about 13. Tom, I can't keep up right now. Yields this morning up another 3 basis points on 2s to 54, on 10s to 157, up 2 basis points. And the conversation within a week has gone from central banks pushing back against hiking anytime soon. I think the Bank of England, the Federal Reserve. Then that one CPI print, Tom, changed the game. All of a sudden, the hikes get brought forward again. Wells Fargo, the latest, early this morning.
And again, I'm going to go to what I've heard from people, even people who are on the edge of transitory, John. It was the breadth of the data, not one specific item. I think that's important.
Yeah, and let's talk about what the curve looks like now as well, Tom. So switch up the board and finish on the chart. 2s, 10s topped out at about 157, pushing 160 at the end of Q1. We had a breach of 100 to the downside earlier again this week. 103 right now. Tom, the curve is flatter. Does this make it difficult for the Fed to tighten anytime soon, to see the curve this flat and flattening off the back of some of the incoming economic data? Do they need to push back against that at a time when ultimately people would like them to embrace what they're seeing in inflation and maybe do something about it?
I think it's a little bit of overanalysis. I think what they're really looking at is the next month's data. I think they're absolutely slaves to 1, 2, 3 months of CPI data, and we've got, I don't know what the calendar is on that, but we got to get there.
Well, let's talk about next year's data. Wells Fargo looking for 2 hikes next year, Q3, Q4.
Look at their
2
GDP
additional hikes through 23, and a GDP number, Tom, with a 4 handle for next year, CPI with a 5 handle. Now, I understand for the bonds guys, that might be a scary idea. For the people in the equity market, I know some equity bulls, Tom, who will like that trade. They'll like the idea of, yes, inflation is high, but ultimately, if real GDP is kicking out 4%, pushing 5%, well, they'll stay long.
And it pushes against folks. This is really important. The Goldman Sachs call and others looking for some form of trend down towards potential GDP. Wells Fargo really taking a different tack. Right now, let's go to George Goncalves. This is really important. He's head of U.S. macro strategy at MUFG, and he writes one of the most interesting, and George, I love saying this to you, twisted notes on Wall Street, in that it's very thoughtful, paragraph to paragraph, about what the unseen is out there. George, I love what you say about the lack of depth in the 3-month market. The gloom crew is worried about liquidity. They're worried about savings dynamics, and you're focused on the lack of depth in treasuries. What do you mean?
Well, I mean, look, 2021 definitely is going to go down as a year that the bond market could not catch a break. And we started off, as John was pointing out, with the 2s, 10s curve steepening, really kind of encouraged further steepeners. Those trades got unwound. Then during the month of October, around all the central bank kind of interventions, which they obviously didn't really deliver hawkish messages or hikes from the BOE's point of view, really tripped up all these short-term rates markets. And then now, as we head into year end, where liquidity is super precious, we're seeing some forms of cracks forming. I mean, it's too early to say, but if you look at the government liquidity index on the Bloomberg terminal, you compare against MOVE. I think there was a good article by someone on the Bloomberg team that put it out there. But there is some concerns. I mean, both in the bond market, but I think that if this were to persist, I think other markets would care as well. I mean, the bond market is the first to feel these things out.
Right.
And if you look at the bond market has more than one curve going on right now.
Well, let's go there. I got three ways to go here, folks. And what Mr. Goncalves mentions there about the bond market is out front, I firmly believe in. I've seen it time and time and time again. What is the bond market telling the equity market in 6 months?
Well, I mean, right now, because CPI, I think, finally is a wake-up call, because the fact that it continues to stay persistently high, this reading is the straw that broke the camel's back on the long end of the curve. And we saw that in the really poor auctions of the 30-year. But again, even then, it's good to kind of get around the idea that we're going to have positive, strong growth next year and high inflation. But if inflation persists at this level, I think other markets are going to start to care, because it could, fast forward, Fed action. And even if it's just 2 hikes, maybe a faster taper, markets broadly are not ready for that.
George, let's have Therapy Friday. Why are bond traders so gloomy?
Because we're realistic, I think.
No, I ask this seriously because whenever I read notes, and frankly, I gravitate to the bond market, as many people would acknowledge for a reason, there have been a lot of prognostications about cracks forming. You really talked about the idea that as a tapering starts to accelerate, it will reveal some of the significant cracks in markets. What is the bond market so worried about that will happen as the Fed starts to more meaningfully pull back?
Who's going to warehouse all this risk? I mean, it comes down to just that. We saw massive QE. To expect it to kind of just go away, quietly into the night, that to me is wishful thinking. I think the bond market knows that. And so you're seeing, multiple bond markets, forming around a central core of the Treasury market. The Treasury market is made up of on-the-run benchmark Treasuries, which everyone looks at every day. And then there's the bonds that trade around it, these off-the-run Treasuries, which start to get less liquid, especially this time of the year and with the Fed stepping back.
George, in some ways, are stocks and bonds switching profiles where you start to see bonds becoming the more volatile asset class and sort of equities following along with this presumption that central bankers will step in and stem declines, create a backdrop where TINA still will exist?
I mean, that really comes down to, which I think we discussed in other episodes, it comes down to the credit market, which is kind of in the middle of the two, right? So if you look at just once rate vol starts to infect credit volatility, and then I think then equities will matter. But until that happens, there's so much money chasing yield. And so as long as that dynamic's still there, then credit should, hang in there, and then equity should as well. But I mean, I think ultimately if the bond market gets a little bit illiquid, it's going to hurt others.
Is the so much money chasing yield a 2006 equivalent?
That's actually a great point, because if you look at the way so overall vol and how the last year of that period of 06 when we got a lot of complacency in the markets back then. We're like, hey, things are going to be super smooth forever. We're going to have this positive kind of reinforcing mechanism on growth, and it didn't last until 2007, 2008. I don't think we have to have a repeat of that per se, but we've been on the back of central banks' largesse and fiscal supply and fiscal stimulus, and now that's going away. And so I think that probably 2021 is like the 06 period, probably this analogy.
George, a delicate question, but with MUFJ's Japanese heritage and Japanese reality, what are the lessons from Japan the fixed income market in the West needs to understand right now?
That, eventually, if you don't get the growth, the deflation always wins.
Going forward, what are you looking at in terms of the trigger point for the long end? You said that this was a wake-up call, the CPI print, yet the wake-up call seems relatively muted when you take a look at the flattening yield curve that John was talking about. What do you expect to happen here as the wake-up call becomes more widely accepted?
So, I mean, look, in general, we'll see more curve volatility relative to specific points on the curve. So if the curves continue to kind of move in erratic behaviors, I mean, it's been in a flattening trend, so it's hard to kind of distinguish that, but the realized vol has been pretty high in curves. And so just looking at curve volatility is going to be a big deal. I mean, I do think that, look, on the grand scheme of things, we all know rates are low, but I mean, it's really the starting points that matter. So if we start to move well back above 160 on the 10-year, back above 2% in a meaningful way on the 30-year, that's when I think, we'll start to see some concerns about people that got long basically at the lows in rates when they knew growth was strong and inflation was super high, right? And if it keeps going, then that's when I think you have less interest in further tails and things like that that I think you guys cover well on Bloomberg.
Hey, George, we appreciate that. Thanks for the kind word. You're welcome back anytime. George Concava's there of MUFG on this bond market. I went through some of the weekly moves. We've had 2s, 10s, look at 5s. The team here at Bloomberg reporting we've had a 20 basis point move on 5s this week. Could be the biggest weekly surge we've had, Lisa, in about 2 years. That just really captures that rate hike dance that's got pulled forward right again, all the way forward to, say, 2s. We're having that discussion, but further out through the curve into the belly as well.
And this is despite the pushback that we heard from Fed Chair Jay Powell last week when it came to bringing forward some of the rate hiking activity that a lot of people are expecting. I do wonder why we are not seeing more of the volatility in fact equities. I think it's an interesting switch because equities used to be the more volatile asset class, and in some ways the low yield environment has sort of underpinned that there is no alternative trade that sent people back to equities, providing a buffer.
Equities this morning doing okay, up 10 on the S&P, advancing 0.2%. The Nasdaq up 48, advancing 1/3%. There's a move in the Russian ruble that gets my attention right now. Dollar ruble, a move of about 1 percentage point. Bear in mind that this year the ruble has seen some real strength. We're starting to give some of that up in today's session, Tom, after the United States reportedly warned Europe that Russia may be planning a Ukraine invasion. They may be planning one, I stress. Take a look at the story on the Bloomberg overnight for some more details on that. TK, there's the move for you. It's about 1 percentage point, back with a 72 handle. I stress that over the year it's been about ruble strength, but right now we give a little bit of that up.
Percolating this morning, John, there's 3 ways to look at ruble: dollar ruble, euro ruble, and then there's a convoluted basket, which I've never really understood. John, you go to dollar ruble, as you correctly do, but I really wonder, with the challenges of Ukraine, Kiev, only 60 miles south of the border with Belarus, with the challenges Belarus is having with Poland right now, this is combustible. Certainly the reporting of Jennifer Jacobs and the team is this is a combustible mix that the White House is watching.
And Tom, you mentioned Belarus, the conversation around gas as well, and the difficulties they've got with that relationship at the moment between Europe and Russia.
Yeah, again, this goes back to the time of year. John, this is right on cue for November 15th-ish, and I'm sorry, into this, it's sort of the weekend before the holidays, John, on an old-style Wall Street, and the answer is this is the weekend where you start thinking the reset for 2022. What's the reset for Eastern Europe?
The dollar ruble back through 72. It's a move of about 1 percentage point. In the grand scheme of things, not a major one, but a story we're keeping an eye on. Equity futures up 10 on the S&P, advancing 0.2%. From New York City this morning, good morning to you all. Live on TV and radio, this is Bloomberg Surveillance.
John, with the first word news, I'm Rishika Gupta. Johnson & Johnson reportedly was split into 2 companies, according to Dow Jones. J&J will spin off the $15 billion a year consumer group, which makes products such as Band-Aids, Tylenol, and Johnson's baby powder. The other company will include J&J's prescription drugs and medical devices business. Oil is heading for its longest run of weekly losses since March. President Biden is keeping investors guessing whether he'll intervene to hold down prices that have hurt consumers. The price of gasoline in the U.S. has hit a 7-year high. The president is considering a number of moves, including a release of oil from the Strategic Petroleum Reserve. At the Climate Summit in Glasgow, talks on creating a global carbon market have run into new obstacles. Countries disagree on how to account for emissions credits that get sold. Talks will continue today with less than 24 hours to go before the summit is set to wrap up. And Donald Trump has got a court win to shield his presidential diaries, call logs, and other records for now. A federal appeals has temporarily granted the former president's request to keep the documents from being released to a congressional committee investigating the Capitol riot. The court will hear arguments in the case November the 30th. In Florida, a prosthetic tail dolphin named Winter that starred in the Dolphin Tale movies has died. Officials at the Clearwater Marine Aquarium say they were preparing to treat the dolphin for a gastrointestinal abnormality. Winter was 2 months old when she lost her tail in a crab trap. The movies chronicled her recovery. Winter was 16 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How much stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. They're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
We need to be doing way more immunization. We still are under 60% of the total U.S. population immunized. That's why we're still seeing so many cases and why we're seeing so many deaths. We really need to now address the vaccine hesitancy and the folks who are, still unwilling.
Dr. Chris Breyer there, the Johns Hopkins Bloomberg School of Public Health professor and epidemiologist. From New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market up 11 on the S&P, advancing 0.25%. A weekly loss, that's what we have in store coming into Friday. Down about 1% on the S&P 500. Looking to take a bite out of that around the opening bell. Yields are higher on the week by a fair bit, up another 2 basis points on 10s to 157.16. On 5s, the team here at Bloomberg pointing out we're up about 20 basis points on the week so far on a 5-year yield. That really capturing the inflation debate and what it means for higher interest rates. And there's a move on crude, TK. It's a break of 80, briefly, 79.99. We're down about 2 percentage points.
I'm going to call it from 85.84 back to 81.47 on Brent crude. Just an ease away, as you mentioned earlier, John. Maybe a grind. We've got a lot of questions on the pandemic. John and Lisa are going to tackle those in a moment. I want to speak to Andrew Pekos of Johns Hopkins Bloomberg School of Public Health about the School of Public Health. And, of course, this is Michael Bloomberg of this television and radio operation and his philanthropy with his Johns Hopkins University. Professor Pekos, we have Johnson & Johnson breaking up. They're going to kill themselves over the next months and weeks to tell people it's not about a litigious trail. From where you sit is definitive in virology and epidemiology. Can Big Pharma still act like Big Pharma, or is the litigation risk so great they have to break up?
Well, I think the litigation risk, along with things just as profit margins for things like antimicrobials and antivirals, are the things that I oftentimes hear from some of my industry colleagues that are things that sort of make them shy away from some of these treatments. So it's a difficult thing to understand from my perspective, because the use of antivirals and antimicrobials is such an important part of our treatment regimen, as we've seen over the last couple of weeks with some of the data coming out about COVID antivirals. You'd love to see a greater investment in generating those compounds. And maybe mitigating litigation risk is one of the ways that you can stimulate some more interest in there.
The romance of this, of New Jersey, back 50 years, I think of the giant Gordon Douglas who ran J&J Vaccines years ago. That almost courage that they had scientifically, is it now a new timidity that forces someone like J&J to break up?
Well, you've seen the rhetoric right around COVID-19 vaccines. And again, I sound like a broken record with this, but the facts are the facts. We've got one of the safest and one of the most effective vaccines against infectious diseases available right now. And we've got pushback at all levels, not just from hesitancy, but people who are adamant about side effects and other things that are coming from the vaccine that really there is no data to support. So one understands the risk of that from a company's perspective. It's difficult from a scientific standpoint to really understand that.
Andy, to that point, some nations are taking a harder approach when it comes to getting people vaccinated, including Austria, which basically is locking down some unvaccinated individuals in the country in order to stave off the spread of the virus. Is this the way to go?
Well, the important strategy is to vaccinate more people who aren't unvaccinated. And you're seeing lots of countries finding ways to try to get those people to understand that vaccination is the safe route forward for population immunity, and to understand the risk that unvaccinated individuals pose to even the vaccinated population.
Andy,
so
in all honesty, though,
creative.
We've been saying the same thing, though, for months, right? And here in the United States, we've seen adult vaccination kind of plateau out. Yep. There sort of are those that are and those that aren't, despite what you're talking about. Is taking a harder stance, or taking Singapore's stance of just kicking people off healthcare if they don't get vaccinated, is that what has to happen to get more people vaccinated? Or have we moved to a place where it's really an individual choice and the public health concern has been really stripped away more significantly?
It still is the important thing is to get people vaccinated, and it starts with a safe and effective vaccine, and other ways that you can move forward to get that in the population are things that are needed to be done, because we won't boost our way, as many people have said, we won't booster our way out of this pandemic. We have to get everybody to either get the vaccine or do things the hard way and suffer through infection to try to get some level of immunity. And we don't want the latter because of the cost that takes, not only on human suffering, but also the overload that it puts on our hospital system.
Do you assume, like tetanus, we have a reboost X number of months / years out?
So this is the most important thing about boosters that I feel isn't really talked about much, and that's COVID-19 is here to stay in the human population. We have to find now a way to turn these immunization strategies into ones that get us the longest and strongest immune response. Up until now, we've been focusing on short-term responses, getting protection in the population quickly. We've got to start rethinking these immunization schedules to induce long-term antibody levels. And I don't think that's going to need an annual booster, but it may take a booster over the course of, let's say, 2 or 3 years, and a different schedule of vaccination to give us that long-term immunity that we need to keep this virus away for an extended period of time.
Doctor, thank you, as always, for your insight on this situation. Dr. Andy Pekos there of Johns Hopkins. Lisa, you're asking the question that I think a lot of people are asking. When does it become about personal choice and not the collective? When is it not about overwhelming the healthcare system and ultimately down to people to make the decision? I'm fully vaccinated. I don't share the health profile of, say, a professional athlete. I'm not going to benchmark myself to one. I find it incredibly frustrating, Tom, incredibly frustrating that people continue to do that. It's absolutely ridiculous. I think we talk about them far too much. They have 8% body fat, access to the best doctors on the planet, Tom.
I love that he
and
knows this.
for some reason, people think it's a big deal that they haven't been vaccinated. If they choose not to, let's just not cover them. Let's just
Hold on
not
a
cover
second.
them.
But that's where the public health aspect comes in, right? And a lot of people are saying we still are dealing with a public health crisis, not yet individual choice, because you're seeing the numbers plateau at very high rates with respect to hospitalization in the United States. And then you see Germany, you see a lot of places in Europe seeing surges that are concerning. So at what point does it shift into an individual versus societal question? I don't know the answer.
And John, I think you're way up to speed on this. I had a conversation earlier this morning with London about our plans for Davos, and I'm sorry, it's not just Austria, but selected countries in Europe, including Switzerland, where Davos is, are struggling to figure out how to get control of this. They're not like the United States right now.
And that struggle is getting harder as we get deeper into the colder months of this year. This conversation is going nowhere anytime soon.
John, they're talking about distance seating at the piano bar.
Are they?
How do you sing Sweet Caroline at the piano?
We tried every morning.
Midnight if there's distancing.
I think, as usual, Tom, I'll give it a miss, and I'll come find you.
You'll give it a miss
at 2 a.m. in the morning and walk you home and take care of you,
That's
like
okay.
I
Sweet
always do.
Is that really what happens?
Whoa, whoa, whoa.
Lisa Bramwitz, Jonathan Ferro, and Lisa, if you come this year, we'll start a rotation. You're not going to escape this, okay? We'll have a
I
rota
can't wait.
from New York City. This is Bloomberg.